Hello, everybody, and welcome to Montel's German Energy Day 2023. It's a great pleasure to have you all here. I see some familiar faces, some new ones, which is very nice indeed. Now, my name is Richard Sverrisson. I'm the editor-in-chief at Montel News, also the host of the Montel Weekly podcast, which some of you may be familiar with. And I have several members of the news desk here on the front row who will be covering it, and some other reporters as well. And we have a lot of my Montel colleagues here who will be here to assist you throughout the day. Now, this is our 20th event in Germany. It was called the European Energy Day before, in the first few instances. The first one was held in 2004. And the years since have been quite eventful, shall we say. We've seen, amongst others, a carbon boom, bust and boom. We've seen the financial crisis and COVID. Now, let me just get onto the slides here. Just a short bit of housekeeping before I go on any further. We'll provide you with a documentation. Please switch off your mobile phones, even. Not the mobile food. And yes, and we will have a nice dinner in the evening on the Rhine. Let's hope the weather is nice. Now, so as I was saying, the last 20 years have been very, very eventful, but nothing compares to last year. We saw unprecedented turbulence in global markets, with the energy war at the center of it all. This was uncharted territory indeed. And today we will look at the way forward. And our speakers will help us to give us an outlook of what we can expect this year and beyond. But I think the important thing is to stress, okay, we may have been lucky with the weather. We had a mild winter. But Europe came through it, and I think it was a remarkable success, the way Germany and Europe managed to wean itself off Russian gas. And from when we were here in October last year, and that was almost at the peak of our concerns going into the winter. And certainly prices were very, very high. I think we were about 350 euros a megawatt hour at that time. In power. This is the front month for gas, but it shows that the peak at the end of the year, we've come quite rapidly off the peaks that we saw. Prices are still very high, but the question is, are we out of the woods yet? Is this the end of the energy crisis? And I hope some of our speakers will be able to enlighten us and answer that question. So this week has been fairly interesting as well. We've seen Olkiluoto 3 come online in the Nordic region. 14 years late, but it's online now. It's producing power. But in Germany, we've seen the nukes being shut down. So that's quite a contrast. It's quite interesting contrast there. We've seen, earlier this week, we saw negative prices in the Netherlands. Massive amounts of renewables, both solar and wind, caused prices to tumble to minus 195 in some hours. And we are still in the midst of a cost of living crisis, so that shouldn't be forgotten. There's inflationary pressures, strikes, and ongoing problems at the French nuclear fleet. And there are question marks over the outlook for industrial firms, and several of them are here, and we look forward to their presentations later, giving us their views on what we can expect in the years to come. Industrial gas demand has fallen by close to 20% in many countries in Europe, including Germany. And there is, we talk about a threat of deindustrialization. Is that a real one? And I think, should industry, for example, lock in the prices we saw on the previous slide now, or expect prices to fall further? I mean, these are key questions and are very representative of what's happening in European for the European industrial firms. And I think another throwing a big aspect of this here is is what's happening in the US. And so subsidy race for renewables, for firms willing to invest in renewables. The Biden administration's Inflation Reduction Act is certainly causing a lot of firms to consider relocating to the US. And we've certainly had noises from battery firms saying, yes, we will relocate to the US. And I think that's certainly a real concern. And I think finally, we will talk a little bit about market reforms and market design, but this has to be set against the context of increasing pressure or increasing focus on profits and bonuses made by energy firms. And I think this is going to be a very tough debate to be had when you have people who can't afford to pay energy bills, but you have profits and bonuses at these energy firms. Here are the oil and gas firms, but certainly some power firms also, famously in Denmark and also in the Nordic region where bonuses have been very high. That's not to say, I'm not saying that's a bad thing, but I think you have to put it in the context, and there'll be increased pressure on policymakers to be seen to be doing something about it. We will look at the future of energy trading, set against all these market reforms. But there is also talk of, the war in Ukraine, increased inflation, people can't afford to pay for basics. And then you have, there's talk of, even I've heard talk of blood money, people profiting from the war in Ukraine. I think that's quite a drastic step, but I think that does show the context in which a lot of the politicians are operating. But anyway, now, this is our program. So we'll start off looking at the energy crisis. Is it over? And the outlook for the next winter. Then we'll look at the discussions around market reform, market design, and the future of energy trading. And then we'll look at, after lunch, we'll look at industrial firms in Germany, greening industry, and the role of PPAs. Before we round off the day, we're looking at short-term power markets and batteries. So a full program for you today. I hope you will have a lot of your questions answered, and we'll have a clearer outlook about what's coming in the months ahead. Now, also a big thank you to all our partners and sponsors who are all outside here in the lobby, should you wish to speak to them later. But that's pretty much enough from me. I hope you enjoy the day. And I'd like to pass over to our first speaker of the day. Tobias Federico, Managing Director and founder of Energy Brainpool, one of Germany's foremost energy experts, and he's been covering these markets much longer than me anyway, and I've been doing it for about 20 years. So Tobias, the floor is all yours.
Super. Thank you. Forward, backward, that's it. Yeah? Cool. Thanks a lot. So thank you, Richard, for the introduction. And yeah, warm welcome from my side. I'm Tobias Federico. I'm the Managing Director of Energy Brainpool. I just want to start my timer, so don't worry, I'm not checking the latest news. So yeah, indeed, actually I have an anniversary to celebrate this year, actually also this month. It's 25 years since I'm working here in the energy sector. I started on the 1st of April, and it was no joke, 1998. And in this time, the German market has been liberalized, and my first job was to build up a power exchange as a small consultant in a big consultancy group. It was quite exciting because nobody knew how to trade power in that time, except of the Norwegians, because they already had Nord Pool. Since 20 years, that's another anniversary, I started Energy Brainpool, so we are now 20 years old. And I'm speaking for Montel since 17 years, so not almost 20 years, and this was really great. And I actually found the old presentation from 2006 of the fundamental power drivers, and it was really interesting to see what did I tell the audience in that time. And it was quite memorable because I think it was in Oslo. It was this, we expected a shortage in the power and the emission sectors, and we have been wondering because our models have been always wrong, because we always saw that we had a long position in that time. So we had to tweak our models to forecast the total emissions that we had a short position, what the market expected. In fact, the market was quite long, and I think this was one of the first presentations I gave to that topic. And I found the slide, so once upon a time, this was our old design. So I talked about the emission markets, but what I also did in that period, we had the first Ukrainian-Russian gas dispute in that period. And I'm a big fan of geopolitics and energy, and the combination has a lot of fire, as we have seen last year. And in that presentation, I was also talking about the Russian-Moscovitian buffer zone. Since 300 centuries, Russia has built up a buffer zone between Moscow and Western Europe, and they all have lost that, in question mark, in 1991. And the idea in that time was, well, this is still a threat. And actually, we are here today after the crisis because this is one of the crazy ideas of increasing territories from Russia, which all caused the crisis we are having here and the global crisis. But coming to the point, crisis, what crisis? And it's interesting to see we have, even within the energy sector, and energy is always mixed with politics. We have people who try to understand the market and really try. We have people who understand the market, but we have a lot of people who really don't understand the market. And the biggest difference is, what's the difference between capacity and fuel? And looking into Germany, in Germany we don't have a power capacity problem. We don't have that. We had a fuel problem. Because we still had a lot of installed plannable capacities. Due to the coal phase-out, we had a lot of coal power plants in reserve capacity. We still had a few nuclear power plants. But we had the fear of missing fuel, natural gas out of Russia. Russia was delivering 55% of the total energy, natural gas demand for Germany. So due to the invasion, we had to replace that. But the discussion was always about, the nuclear discussion. We need the nuclear power plant and so on. But the biggest threat we had for last winter was really that missing fuel was there. And talking to the politicians, it was interesting because they have made, in the last years, always a yearly risk assessment regarding fuel. So what's with the fuel supply? And they just copied the same phrase of all the 25 years before. Fuel delivery is always guaranteed. And it was always guaranteed until the 24th of February 2022. And that was our problem. So we had missing fuel and not missing capacities. Therefore, shutting down the last nuclear power plants, which was around about 3 gigs, wasn't a big deal from the energy market. Okay, we are coming in summertime, might be a deal next winter, but still we have enough plannable capacities in the system. Beside all the political discussions which is coming up right now, we still need them and so on, but we are now in April. The winter is gone, so the winter 2022-2023, we managed to deal with that. Why did we that? Because we had enough fuel. We have been able, and this was really amazing, especially for Germany, to handle big asset investments. We have not been able to build up 1 LNG terminals within 40 years, and now we are building up 5 within 1 year. Okay, it's floating LNG terminals, but this was really helping us, beside the reduction of the natural gas demand. I think in total it was 10% of demand reduction in the sector, mostly price-driven. And here comes the discussion with the deindustrialization. Did some industrial consumers switch to another fuel, which mostly is not easy? Or did they really reduce their production or shifted their production to somewhere else? But nevertheless, we have 10% lower natural gas demand. We have been building up the LNG capacities, and we have been able last autumn to fill up our gas storage capacity. You must remember that Germany has worldwide the 3rd or 4th biggest natural gas storage capacity in the world, which helps us quite a lot. And of course, the winter wasn't really cold, and the current level, I think, is 60% of Germany's natural gas storage, and we are in the middle of April. So it will be very easy to fill the gas storage up for next winter. And then we still have to hope for the winter not to be too cold. And we have been building up LNG capacities. So in the end, we tried and we did, with a lot of success, solve the fuel problem. Of course, we had some other issues regarding ownership and ownership structures with Gazprom Germania, now securing energy for Europe. We have the same part with the oil sector, with Rosneft, but even there the German government did a very good job. So we had a fuel problem, we have been able to manage the fuel problem, that's fine. But still, winter is coming, and this time we are prepared for it. And that's good. It doesn't mean that we might not have a problem. It could well be, when it's really cold and very long cold, and we might have a capacity issue due to sabotage. Could have happened, should have happened. We've heard the recent news regarding Nord Stream 2 and some interesting vessel movements around that from Russian ships before the explosion. So still something could happen, but we are better prepared than we have been last year. So therefore, I would say the crisis in this case is not over. We might be in the middle of the eye of a hurricane, and the wind might blow from another direction coming out of that. And what is this direction? First of all, it's politics, and second, it's politics. Why is that? Well, first of all, we have in Germany, we have a new law, which is the revenue cap on over-profit in the sector itself. It's in place to refinance low electricity bills to end users, either industrial or household. And this, even though it's in place and we have very low power prices compared to the price levels which have been given there, the earnings are not quite big in a sense. And the good news is that the power prices currently are so low that it's quite unlikely that the politicians will renew this revenue cap for the second period, because it was only, I think, until April next year, I'm not sure. And there was the idea, okay, depending on the power prices, are we going to renew that or not? Power prices are so low, and they will stay quite low, at least in the summertime. We come to that later. And so that it's quite unlikely that it's going to be renewed. The bad news is that CFD, contract for differences for renewables, might come. And that's currently in a political discussion, something I really don't like. CFD is that you're only allowed to earn something on the power market, even though you have a merchant power plant. The difference you have to give to the government, or the government pays to you, which is a little bit counterproductive to hold the market idea of renewables. This is one side. The other side, understanding market design. Yeah, this is something where in the last month we've seen on the German level and on the European level that there have been a few issues, especially looking into the point of, well, what's the merit order? Is the merit order the market design? I don't want to start that discussion again. Or do we have a two-sided auction, which is the market design, either an open or closed order book, but that's completely different. But even the merit order model has made it to the main boulevard press headline, and that's something where I say, okay, everybody's speaking about the merit order, but nobody's really understanding what it is. But the second part, which is much more interesting, is, and I don't want to talk a lot about it because later on Andreas will definitely speak about it, is the LNG market. The LNG market works completely differently than the pipeline market. And for my personal opinion, and it's my personal opinion, we can later on discuss about it, you can only play the LNG market in case you have overcapacities. Because when we have the pipeline market, and the pipeline has one flow direction, you plan the capacity, you see your regional demand, then you plan for storage, and that's it. But with the LNG market, due to the fact that the flow of gas might change direction depending on the worldwide market behavior, you can only play this market correctly in case you have overcapacities, either on LNG storage itself, so the LNG capacities to regasify gas, or gas storage itself. And we are currently seeing discussion in Germany that, oh, we have enough terminals, we don't need any more. Or we have enough gas storage capacity, we don't need that anymore. But if you want to play the market, and we've seen that in September for a few weeks, where we had very low gas prices, LNG vessels have been floating, idling in front of the Spanish coast, full with natural gas, because the prices have been so low. For them, it didn't make any difference. In case we would have had higher capacities, either LNG terminal capacities or storage capacities, we could have played the market even better. So the LNG market works differently and only works with overcapacities. And of course, then comes the discussion, yeah, but the investments, we are paying billions for these overcapacities. True. But compared to the value of the commodity in case of a shortage, it's really marginal. And that's something the market might have understood finally, but the politicians didn't understand it up to now. So it will be very interesting discussions here. Currently, we have one LNG terminal being built up in front of the island of Rügen, which is a touristy island. But the terminal is not in Rügen, it's in Ludmin, which is the landing point for, or which was the landing point for Nord Stream 1 and Nord Stream 2. And, but the floating ships are in front of Rügen. So here the political discussion starts. Yeah, we need the energy turnaround. We want to have really renewable gas, you know, but we don't want to have natural gas. So we would like to have everything H2 ready, so hydrogen ready. And it should be green hydrogen. And H2 ready is always like, I don't know when you remember the times when we had the first televisions and they sold the televisions as HD ready. Yeah? HD ready meant nothing. Yeah? H2 ready means nothing because you still have to do the investments. Hydrogen behaves differently, whether you work with ammonia or transfer it then to hydrogen, it works differently than natural gas. And I'm also H2 ready, whatever it means. So don't quote that, yeah, please. But the thing is, yeah, the question is, where do we want to go? And last year I always said, well, if your home is burning, and you try to really take water to prevent the fire to be extended, then you're not asking whether the water is contaminated or not. You just try to avoid bigger damage. And the same thing here, natural gas, yeah, of course, it's emitting CO2, and green hydrogen would be far better, but right now we want to avoid the house to burn more. Later on we can ask the question, okay, how can we handle with hydrogen or not? And now we are coming to the second part, are we managing or how can we handle the next years? And in this case, we from Energy Brainpool are calculating scenarios. And there's a difference between a scenario and a forecast. Yeah? Even though it doesn't seem to be a big difference, it is. Because a scenario is a potential development of the future, a forecast is the development of the future. And I don't know the future. I'm not a prophet. I don't have any idea about what could happen in the future. What I can do is, under certain circumstances, I build up one type of scenario. And we have different scenarios. The latest one we've developed is the Go Hydrogen scenario. So we will have a climate neutral scenario all over Europe based mostly on hydrogen. Then we have a Go Electric scenario. It's a different world. So mostly it's electric. So electric vehicles, you do everything you heat with electricity. In Germany, this is an issue. And then we have a Go Nuclear scenario. Doesn't mean that I'm predicting the future for Germany to have nuclear power plants again, but this is one potential scenario. And the truth might lay in the middle. And of course, one scenario, what is always needed is the current policy scenario. So what happens if the current ideas from the politicians will take place and this will be the path of the future? And this is great when you have a model because you can calculate crazy ideas. And that's what we did. So our central scenario right now is the expectation of the current policies of most of the politicians, which means it's mostly based on renewable energies. This is the installed capacity of onshore, offshore wind, which is blue, and the red one is solar, PV panels, either grid scale or prosuming. Prosuming is quite interesting in total. And we have another discussion, which is, and this is the picture for Germany, the development of the peak load. That's the gray line. And our scenarios are running until 2060, and the big demand, or the big question is, how big is the demand in 2060? With all the EV vehicles, heat pumps, and so on. And here, most of the scenarios have the biggest gaps. Yeah, somebody says it will be 3 times higher, somebody says 2 times higher, 1 time higher, whatsoever. This is our scenario, so we do expect an increase of the peak load, mostly flexible load. We call it flexible load because it will be price-driven. And this is just one assumption. Yeah? And out of that, we are getting our power production. Yeah? And the power production here, it's the electricity outcome out of the different sources. And you see, one thing is gas. I was speaking about hydrogen. But speaking about gas, there's a slight difference. Gas is not the fuel in this case. Gas is a gas turbine. And a gas turbine is not called gas turbine because it's burning natural gas. It's called gas turbine because it's an open gas cycle, as when you study thermodynamics, describe it. So you suck in air, that's the gas, you burn a fuel, and something rotates, and then you produce electricity. What the fuel is irregardless what it is. It must not be natural gas. Of course, today it makes sense, or at least it made sense until February last year, to burn the cheapest fuel you can get, in this case, to be burned in a chamber of an open gas cycle, which was natural gas, even though it was quite an expensive fuel compared to coal, but you burn that. Whether you burn gas or hydrogen doesn't make really a big difference. It makes a big difference in the technology, it's different temperatures, you have to exchange the turbine and so on. That's the H2 readiness. But nevertheless, we have installed gas turbine capacities. And that's the technology of the future, whether it will be burned with natural gas, with gray hydrogen, with green hydrogen, with blue hydrogen, or whatever color scheme we will think about, doesn't really make a big difference. But that's our plannable backup capacity. And the rest, of course, will be fluctuating. And you see this additional demand. So we have the inflexible demand, and we have the additional total gross demand. And that's the most exciting part. What will it be? Will it be two-sided grids? Will it be two-sided batteries, I mean? Will it be heat pumps? Will it be electrolyzers, for example, to produce green hydrogen and so on? So here is the music playing. But this is one scenario, and under these general assumptions, we of course have an outcome. And I only showed you the outcome of the next 5 years. The rest does cost a little bit extra. And these are our expectations of that scenario of monthly base prices. It's what's the latest scenario run. And the interesting part is you can compare that with the current price forward curve. And those of you who are trading say, yeah, but this is too much. The current market says something else. And of course, that's the difference between a scenario and the market expectations. And the answers are two-sided. One potential answer is the model is wrong. Yeah, okay, I can live with that. I'm doing modeling since 20 years. Or you say, interesting, if a model says that could be the fair value and the market expects something else, can I do with that something? But the interesting part is, and here comes the insecurity, is this is based on one weather year. Now that Germany has no nuclear power plants anymore, the weather dependency increases, which means that within the next years, the volatility increases, and the risk of weather will increase. So what should we do? Because this is only one weather year. Well, we should calculate our scenarios with more weather years. And actually, we are now able to do that. It's a product which we are calling swarms. So with our fundamental model, which is calculating quite quickly, quite fast, we can calculate 1,000 scenarios overnight. And actually, this is something we are doing, especially to calculate the weather risk. So we are playing with different weather scenarios. We are taking the last 30 weather years. We are calculating with different fuel prices. So there's certain volatility, of course, in the fuel prices. And so on, we have volatility in the demand. We do that. It's like a Monte Carlo simulation, but I don't want to use the name because it's a fundamental model-driven simulation. and the result is a distribution. So we've done that. We are doing this every weekend, and this is the result of 2 weeks ago, where we have our expectations of the current price forward curves and the bandwidth due to the unsecurity of the input parameter, which is fuel and mostly weather, either temperature, wind, or PV. And when you look into the winter period, especially for next winter, also for the upcoming winter, you see huge bandwidth between 110 euro as the potentially lowest price and 300 euro on a monthly base prices in average. And that's the bandwidth, that's the insecurity due to the current situation. Which means that the 250 euro you've seen obviously was one quite cold year, but the potential there is even bigger. What will be the reality? We might deviate also from that, because you never know what will happen with reality. Imagining that we might have a sabotage act with one of our LNG terminals or two. The insecurity in the market is even much bigger, so prices might be even higher. Or we have a really mild winter, a lot of wind, we have so much gas storage, and worldwide we have an economy recession. Who knows? Prices will be much lower. If you would ask me, looking beyond, and these are my last words, Richard, because you're already standing up. Looking beyond, what would be the biggest threat within the next 4 to 5 years? And honestly, I think we might be able to manage the energy crisis and also the inflation and so on. But the biggest threat which might arise is a potential conflict between China and Taiwan. Because if something like the Russian-Ukrainian war will happen over there, the impact to the global economy will be even more. And this is a counter-argument for me with the deindustrialization. Of course, if you look into energy prices, yes. But if you look into strategic supply chains and logistics, it would make more sense to build up production capacities within Europe, just to avoid a potential really huge global crisis due to a Chinese-Taiwan conflict. So thank you very much, and I'm at the end of my time.
Thank you very much for this. That's a lot of food for thought there, an excellent overview and certain scenarios there that you've put in place. I think I'd like maybe to go into a tiny detail here. I see in part of the market reform discussions, there's talk or talk has re-emerged about capacity mechanisms. Is this something that's on the agenda in Germany? Do you expect something like that to be put in place?
Well, we still have an issue, and the issue was there since 20 years, which is if you look into the merit order model, to describe the market, it's here. We are thinking about marginal costs of the last producing power plant. But in case of scarcity prices, you might allow an additional price on top, which then is the idea, at least also from the modeling side, that you can refinance the whole power plant in a few hours of scarcity prices. But it means that you should allow high electricity prices for a certain period. And we've seen last year that this is something politicians don't want to have. So it's not currently into discussion because we are looking into refinancing renewables and CFDs, but I think it's still an open question and we still have to answer that. And I think something has come into this direction because obviously the market is the right mechanism to do so, but it's not the accepted mechanism from the politicians. So there must be find a solution, but it's not currently on the table.
And I've seen talk of a potential massive rollout of gas-fired capacity in Germany. Would you agree that that's necessary, or
yeah, absolutely.
To what extent?
Yeah, well, we are calculating things always backwards. Do we have a shortage in a given scenario? Yeah, we have. So we have to build up capacities. Looking into production capacities, looking into LNG and gas storage capacity. It's an answer I can't give you right now. It's a tough one. Yeah, When I say overcapacity, what does it mean? 5%, 10%, 30%, 100% of what we really need? I think a good guess is always in the middle, and the middle is always a quarter, so 25%. But it's a guess.
Thanks for that clarity there, Tobias. I think it's also the issue here is who's going to build them when, as you mentioned here, politicians are very frightened of when power prices or energy prices go beyond a certain level, which is understandable again as well. But an interesting discussion, and I'm sure we'll continue that. Any questions from the floor? Yes, over here. Please state your name and organization. Thank you.
Hi, Tim Hünecke from Encarvis. Thanks for your presentation, very insightful. One question on one of your comments. So I share your skepticism on CFDs, but CFDs are not CFDs, right? So there are different types. And recently I read a paper on financial CFDs, where you don't basically base your settlement on the plant itself, but on some reference. So what do you think about that?
CFDs are not CFDs, but still they are CFDs, which means I'm quite critical about CFDs in general. Because as you mentioned, when you make financial CFDs based on reference power plants, there you have the deviation with where's my local position compared to the reference power plants. Am I getting the wind earlier or later, or the sun earlier or later, and so on. So that's an issue there. The question is also, is it based on a monthly average production or on an hourly production, and so on. So you can design the CFD in a different way, but the biggest fear of a CFD is when you make the design in a certain way, the market will adapt to it, either in the location where to install and how to steer the power plant, only due to how you've designed the CFD on paper. And that's the biggest fear of CFDs, because it could distort the whole market. Beside of, well, what's the purpose of investing? To have one of these upsides. And it was there, yeah, great, but it wasn't there because you invested, it was there because something else has happened. And the CFD is avoiding that. So you hedged somehow, but the fun is gone when you hedged. So that's why I don't like CFDs in total.
Excellent. Tobias, in the interest of time, I've a few more questions, but I think in the interest of time, we have to push the program on a bit. So once again, many thanks, Tobias.
Thank you very much.
A little present from us. Thank you. So Tobias mentioned LNG, and we're going to have a deep dive into the LNG, into the supply and demand fundamentals and the outlook for the months and years ahead. And to talk us through that is Andreas Schröder, who's Head of Energy Analytics at ICIS. Please, Andreas, the floor is all yours.
Yeah, thank you very much for the invitation, Richard. And so my name is Andreas Schröder, and I'm Head of Energy Analytics at ICIS, talking about LNG markets today. And I'm going to make 3 claims today. So I have 20 minutes, 3 claims. First one is it's all about demand savings, really. We've seen that last year, and it's continued. It's going to continue this year. We're going to see demand savings, and it's important. Second claim is there is going to be spot dependence for LNG imports into Europe. And then also I will close with a price outlook, which looks as if price is going to stay at an elevated level compared to the past. Yeah, so let's talk about demand savings, but I'll start with the supply outlook. The LNG global, so we've got to look at the global market here. And the supply outlook is pretty gloomy. Yeah, so there's not a lot coming. All projects that we see coming are depicted here on this graphic, and it's pretty, quite little. So here you see 2022. We had some terminals in the US coming. Calcasieu is a new LNG terminal, but that was about it then for the vast amount. And then during 2023, so this year, we expect very little supply side additions, terminal capacities. And it's only in 2024 that we expect the next wave of terminals, but even here you might imagine looking at the Russian terminal that could be delayed even further. And even the two US terminals that we see here, Plaquemine, Golden Pass, something we optimistically expect for end of 2024, but even that could be delayed. Yeah? So the supply side is sticky. There's not a lot of new terminals coming. So it's all about the demand side, really. What can we save? Who is demanding how much LNG? And that's going to determine the prices then. And so the demand side, we expect that to react to the supply shortage on the global scale. All eyes are on China. The LNG markets globally very much depend on that country because it's second or first demand country in the world, and it's going to come back. They have demanded 21% less LNG past year, but they are going to come back this year, at least to some extent. Yeah? And our expectation is, what I'm showing here is they are growing back again 15%, so back to 71 million tons, 72. That's not a skyrocketing demand also, it's not an immense gain in demand, but it is some normalization, so to say, of China. Maybe not in the beginning of the year, yeah? So this is why our curve is increasing towards the end of the year. But in winter, that could be again a cold winter with China peaking, and then also it has repercussions for the whole global LNG market. Therefore, we all look at this country. There are some domestic production issues we're watching. So domestic production in China is increasing. Also Russian imports into China are increasing. That can play a role for LNG imports, but overall the picture is clear, it's going to come back. Talking about Europe then, so although all eyes are on China, in the end what we can do as Europeans is to save energy, and that's clearly the cheapest option for us. And we have done a great job, I think, in Europe past year, 13% gas demand savings, and we are on track to deliver the same number this year. So we are around 13% this year. And of course, weather helps. Weather helps, and it did so last year. I was looking at the numbers again. So we saved around about 55 BCM gas in Europe last year, and 1/3 of this roughly was weather-driven. Yeah? So the mild winter helped. And a fifth or so, like 20%, was due to industrial production cuts. So the high prices, they trigger some demand response on the industrial side, and we're expecting this to some extent as well, but not as dramatic this year because prices have come down, and we see ammonia producer, fertilizer industry coming back, chemical industry coming back, and also we see that in the power market. Yeah? So therefore, we are often looking at the fuel switching price corridors. They are super important to determine how quickly is the power sector coming back. And we are really in midst of the fuel switching corridor, so to say. So gas plants are being reactivated, or they're coming to the market again at these prices. The storage situation, as you know, it's pretty healthy. We have record high storage levels overall. But this is something we should not just take comfort in seeing this and not do anything. We have run scenarios with our tools to look at how could that develop over the coming winter. Yeah? So here, this is an example of where my colleague Paula, who's here as well, she ran a bunch of scenarios looking at, okay, how important is actually demand savings and how important is LNG imports? And both are, in our view, main determinants of how we can, how our storage situation looks at the end of the coming winter. So we might, in a scenario where we have very little demand savings and very low LNG imports, we have a problem. So we would end up at the storage situation of below 10% at the end of the winter. And so that would be quite a dramatic situation, I would say. We should avoid this, and a good way to avoid it is to save energy. It's just as simple as that. So clearly, our analysis points to the importance of demand savings and to the importance of also securing LNG for Europe. This is just another way and another analysis we did, but it's driving the same conclusion. Yeah? So we ran scenarios with 5% demand saving, so that would be maybe a cold winter or so, where the fallout of Russian demand this year would have to be compensated quite a lot by LNG. Yeah? And we would need much less LNG, minus 17 compared to last year, if we made demand savings of 15%. So here again, same story, save demand to import less LNG and to make it cheaper. The second topic I want to raise is how do we secure LNG in Europe? And there's a lot of happening on the LNG side in Europe, not only terminal infrastructure, but also on the contracting side. But the point is there's too little happening, so therefore we expose ourselves to spot markets. And looking at the global picture, so we have at the moment pretty strong LNG imports into Europe, continued. Yeah, so watch at the green bar. Europe's import this quarter, first quarter 2023, have been almost as even higher than past year and almost as much as Q4 last year. And Asia is slightly coming back. Yeah? East Asia is slightly coming back. But overall, we could say the situation really continues as we had it at the end of last year. And what we observed, so the new element really is Europe now has a lot of regas terminals, and they are pretty well used. Yeah? Especially in Germany, and I'm looking here at the German terminals, but I include Eemshaven, which is at the border, Germany, Netherlands, quite relevant for the German market as well. And all of these terminals, which have been, these floating LNG terminals, which have been built over the past few months, they are quite fully utilized. Yeah? So at the moment, we manage to attract LNG into our markets, but most of this is spot LNG, yeah? So therefore the high prices. This was a list of regas terminals. I'm skipping that to point your attention to this one here, which is the LNG imports and how that compares to the contracted volumes. Yeah? So we remember the Chancellor Olaf Scholz, he went to Emirates, he went to Qatar to secure new LNG, but little came out of that. Yeah? So there's only a bunch of contracts that have been really secured with clear destination clauses. We have counted 6 overall for Europe since the outset of the energy crisis. Most of them going to Germany, 8 BCM roughly. Poland also secured some LNG, Turkey as well. But not all of this is coming immediately now. A lot of the LNG contracts only start in 2026, 2025, when the non-floating, the stationary terminals are going to come for Brunsbüttel and others. And so we still see a situation where Europe is importing way more LNG and continues to import more LNG, even in our forecast. But the contracted volumes are slowly fading out. Yeah? We even expect almost like 8 to 9 million tons to expire at the end of this year. So clearly, message here is Europe needs to secure contracted volumes, and it will do so. And this is the reason why many businessmen and also politicians are underway on global delegations to sign new contracts. We have a contract database where we look at pricing, so it's interesting to look at how these LNG long-term contracts are priced, and most of them are actually secret, so we don't know the exact price formula, but some of them are still oil index. We specifically have that for LNG contracts often. And some of them, interestingly, have US hub prices, so Henry Hub plus 115% often. And increasingly so, Henry Hub is playing a role because the US is just our main source of LNG for Europe. And on the global trading horizon, we see spot markets are still playing a role, although they have been shrinking in their percentage from 31 to 27% this year. But clearly, the majority of global LNG is traded on long-term contract basis. This is specifically the case, mostly for Asia, and less so in Europe. But the culture of the LNG market is a long-term contract culture, and we expect Europe to move to that as well, as they are now building new regas terminals and so on. The long-term contracts so why are people going for that? Because they can offer shelter, because they can give you, they reduce your exposure to the volatility of the global markets, and they give you some form of price stability that you're seeking as you're increasingly exposing yourself to the global markets. Yeah? And this is important, I think, for Germany. We see here the German customs data and how that compares to a TTF price, so clearly contracted data, the gray lines, way more stable than the spot prices. So all of those who had contracts could avoid the price spikes. Talking of prices, our view is that we're going to stay in a world where prices are elevated compared to pre-crisis level or let's say, COVID levels. And even a simple look at the forward curve already suffices to see why that is the case. So this is showing how the whole forward curve moved over the crisis. Yeah, so this was January 22 at the outset of the energy crisis, then moving up really with the explosion of Nord Stream 2. That was really another trigger point for skyrocketing prices. And then we came back, so this picture fades, and then we came back into a world where we are now way lower. Yeah? So this is way lower compared to the crisis levels. But nevertheless, the latest forward curve is still high, or let's say at an elevated level. This is something we've seen pre-crisis, but even higher, especially for coming years. So 2024, 25 prices are higher than what was previously expected before the crisis. And even the first forward curve in January 22 was already a high price. So this is way beyond pre-COVID levels. And it's also our expectation that we're going to stay in such a world. Why is that the case? I explained in the beginning, the global LNG market remains short because the supply side is so sticky and it cannot build terminals within a year or two. There is no such thing as floating terminals that you just build. There's actually one in North America, but that's it. Overall, the sticky supply side means we have to reduce the demand or prices have to come up. And given that situation, we believe the global gas markets are going to stay tight for some while. We even believe that Henry Hub so Henry Hub is the US gas price, even that price can be lifted over time because it's going to go more global. Yeah? There's more export terminals, and the US market, which at the moment is still a bit shielded from world markets, and prices are way lower than world prices or other prices, and it's going to converge to a more global level as we increase globalization in trade. Yeah. I will close with a message about price caps. Price caps are not needed in our view. We don't need these because they create a lot of distortions, but also because at the moment we don't believe in seeing price spikes as we had the past year when we were not prepared for a crisis. And also the EU came up with these price mechanisms and even like a trigger conditions, 180 euros per megawatt hour for the price cap, and then a 35 euro gap between LNG and domestic prices, which would trigger a price cap activation. And then they even invented something even more complicated, a dynamic bid mechanism. So this is another EU invention so you track global prices and then you see, okay, your price cap is actually not even 180, but it's a bit more complicated. It depends on the global LNG price index and so on. We believe these things are not necessary because prices are a very healthy tool to signal scarcity. We have seen that past year, and we often see that price spikes are very short-lived, and you don't need control mechanisms for that. Let me close with that message. And of course, I have to show a product sheet at the end. So this is what we do. We have daily LNG reports, we publish prices, and so on, a lot of analytics. And that's me and my colleague Paula, who will be with us during the rest of the day for questions.
Excellent. Thank you very much. A fantastic overview of what's currently driving LNG, the LNG market, and what could be the drivers going forward. I'd just like to ask you: we've heard some talk of a sort of a surplus or a bit of a glut in Asia. There are full storages in parts of Asia, in Northeast Asia particularly. So do you expect more LNG then to come to Europe as a result? I mean, first of all, the first premise is that there is an oversupply in Northeast Asia. And what could the impact on prices be in the coming weeks? There's also obviously the added element that once the cooling season starts in parts of Northeast Asia, Japan, Korea, China particularly, that could then increase import demand from that region. What are your views here, Andreas?
Yeah, so
sorry, it's a very long question.
No, but I got it. Yeah. So the LNG market in Asia is heavily contract dominated, especially the case for Japan, but also for China increasingly. They haven't taken all the contract volumes, so Japan was reselling some volumes on the market. China did the same, or they have like holding regulations so they can hold off volumes and consume them in the next year or so. And this was happening as Asia reacted to the scarcity of global gas in past years. And but it's a temporary phenomenon, I would say, because China is coming back at some point. They will ease the COVID they already did, and industry is coming back as well. We see very healthy petrochem data, and petrochem is making a lot of the gas consumption in China. So this is an early indicator they are coming back. Yeah? And so I don't see an oversupply situation really for a prolonged period. What helps is Japan and Korea are reactivating their nuclear, so that's freeing up some gas intake. But it's not going to change the whole picture, I would say. Okay. Not enough.
Yep, thank you. Any questions from the floor here? I also have a question, Andreas, about one of the surprising factors over the last sort of few months is that how much LNG still comes into Europe from Russia. I wasn't quite aware of that. Maybe I was a bit naive, but the question is: do you expect the EU to impose a ban on Russian LNG imports?
No, they wouldn't do it. First of all, they have no. So there's a country vetoing this. At least one country, Hungary. But I could even imagine that Italy is also vetoing this because they're taking Russian gas as well. So it's not only Orban, the bad guy, but it's many countries who still take Russian gas. And even the French are doing it. The Belgians are taking Russian gas, but in the form of LNG. So it's still making up a certain share. I think it's 7% or so on natural gas terms, and then you add to this some LNG. And the interesting thing is it's increasing. So the Russian LNG to Europe is slightly increasing over time. It's not at a high level, but it's increasing. So a ban on this would even worsen the situation for no need, because we are not fully dependent on Russian LNG. I wouldn't speak of a dependency, so no need for a sanction. But that's my personal view. Of course, it looks super strange to spend more money on Russian LNG, and that goes into the pockets of Novatek oligarchs there.
And so it's going to Italy, France, but not Germany.
Germany is not taking Russian gas at the moment, and the ministry is insisting that the new LNG terminals, the regas terminals, are not taking Russian ships.
Okay, so they can absolutely certify that that's
But
the case, yeah.
rest assured, we're taking it via Belgium and Netherlands, of course.
Okay. And Italy maybe also. Andreas, thank you very much for your presentation. Here's a little present from us.
Thank you.
So we go from power, LNG, and now to a key aspect of Europe's plans to reach the net zero targets and to decarbonize, and that's the carbon markets. And to talk us through what's currently driving prices and what will drive prices is our old friend Bernadette Pape. So Bernadette, you've been covering this market for many, many years, so you're an expert in this field, so we look very much forward to hearing your views on what's currently happening in carbon and what to expect in the months ahead.
Yeah, happily.
The floor's all yours, Bernadette.
Thank you.
Here's the pointer.
Thank you very much. Thank you very much for the nice introductory words, Richard. Yes, as Richard also mentioned, my name is Bernadette Pape, working as a carbon market analyst for Pact Capital. Actually, I think I have been invited to an Austrian Energy Day, but this is my first time in Germany at the German Energy Day. So thank you very much to Maria, Richard, and the Montel team for having me here. It's quite a challenge to speak about such knowledgeable speakers and before the coffee break when all the eyes are turning already towards the doors. But it has also the advantage that I can refer to the previous speakers and maybe speed up my presentation a little bit to respect the time limitations, because as you might have noticed, analysts are not that strong in this regard. We just want to share the knowledge we accumulated during the years. I'm covering carbon markets for more than 10 years by now. So, as has been also mentioned by the previous speakers and in the introduction of Richard, we have seen plenty of events affecting our lives, both as private people, as employees, and as participants of the carbon market. Here in my first slide, I've just highlighted the main events. Of course, the energy crisis, we have heard a lot about that in the previous presentations, the Ukrainian war, adaptation of reforms. Here I'm not only speaking about carbon market reforms, I will enter into details a little bit later, but if you think about the request of the European Union to save gas consumption, that has affected our lives as well, and also the business of the compliance entities within the European emissions trading system. And of course, since 2018, carbon allowances are financial instruments, as you might be aware of, and therefore we cannot exclude the participation of financial entities. Many of them call them speculators in the carbon market. I will show you in a couple of slides how they behaved in the last couple of months. So let's check how the carbon market reacted on these events. Let me help you interpret this chart. The curve itself represents the price development of the benchmark carbon contract since last September. Actually, almost all my slides will start at that time. And with the little arrows, I try to demonstrate the factors that have impacted the carbon market. I could compare the price to a sailing boat, so there can be winds from all directions and the carbon market reacts. The little red arrows demonstrate the factors that have exercised a pressure on the carbon price, and the green ones, of course, have lifted them. If I have to group these factors into different topics, then I would say that the first and maybe most important topic is still the energy market, the power producer companies, who represent the biggest stake or the biggest share in the carbon market. If you check the verified emissions data that is being published by the European Commission every year, it has been just released in the beginning of the month, you can still see that power companies are the biggest emitters in the sector, and for their electricity production, they cannot receive free allocation, which means that they have to purchase all the allowances in the market. Therefore, whatever influences their business has an impact on the carbon market as well. The second group, let's say, of topics is politics, of course. As you all know very well, this is an artificial market, so it's not a market like LNG or gas or electricity. There is no natural demand for emission allowances from the companies. Most of them, at least the companies I speak to, consider it as a burden on their shoulders, but they have to comply with the legal obligations. So political decision-making can have a huge impact on the carbon price and increase the volatility both intraday and long-term. And last but not least, I've mentioned also in the first slide, since actually 2018, we have to calculate with a special group of market participants who are the financial entities that do not really have any compliance obligation in the system. However, they realized, let's say, the story behind the EU ETS. There is a limited amount of allowances that is decreasing in time, and there are thousands of European companies who have to purchase those allowances. So this is a buy story. The downside with them is that as they do not have a compliance obligation, once they realize that there is a better investment opportunity, they can simply jump out of the market and sell their allowances. Just to tell you one example from my own country, I come from Hungary, the much blamed Hungary. So in my country, for example, if you want to get a good return, right now with Hungarian government bonds, you can get 16, 18% for your money. So of course, and without any risk or any major risk, while the carbon market is still considered as a volatile and therefore very risky investment in the eyes of hedge funds or corporates. So therefore, for example, I've mentioned also the selling activity of grain shares at the end of last year. We could see an intraday drop when they announced that they liquidated a quite big position at the end of the year to pay out dividends from the revenues. Still, comparing the carbon market to other elements of the European energy mix, we can see that carbon market was relatively stable compared to other elements of the energy mix. Here the chart again starts from autumn last year. The prices there count as a starting point, and from there you can see that the carbon market remained relatively stable, while other prices started to decline as we survived the winter, let's say, and we made sure that we are able to provide enough gas, enough power, enough heating to our consumers. Actually, the carbon market has always had its story, and this is in relationship with what I mentioned, the political background, the political support. Because if we think about it, even during COVID and the war and the energy crisis, the European Commission was keen to keep its climate ambition so that we want to achieve net zero by 2050, and the main tool is still the emissions trading system of the European Union, a well-established system as it started already in 2005 with a pilot and then the real system in 2008. So I think that this is also something that we can expect in the future. So we might see huge swings in gas prices, in power prices, but carbon prices will remain stable because of this expectation that it is a tool the European Commission and the European member states are relying on during the decarbonization process of the European Union. A lot has been said about gas prices and power prices, so therefore I just confirm or reinforce what has been said already before. Here again, the chart just wanted to emphasize the significant drop in gas prices since last autumn, what we have seen already previously. And in this chart, I just wrapped up the gross profit, actually the clean dark spread and clean spark spread of German power companies. You can see that this difference has narrowed significantly in the last couple of months. And as we have seen also in the previous presentation, we are approaching the fuel switching levels in Europe. And here I come to the part that has not been mentioned yet in other presentations, because this is related to the role of speculators in the European carbon market. You can see actually the different categories, participant categories, as defined by ESMA, the European Financial Authority. What I would like to raise your attention on is the increasing number of investment funds. This is the gray curve on the top. You can see that there are plenty of companies buying the allowances. However, I still have to emphasize that the big number of companies does not mean that they hold the majority of the positions in the carbon market. So I think the next chart will show it better, that actually this is still a compliance market. So those companies having a compliance obligation or companies serving the compliance entities have the biggest open positions in EUA derivatives. However, as you can see, those investment funds are, as I've mentioned also before, the easiest to jump in and out in the market. My last example is the curve, let's say, between end of February and March. If you remember, these were the days when we heard first about the 3 regional American banks going bankrupt, and then we have received the news about Credit Suisse and being bought by UBS. And actually, at that time, investors went risk off. So they sold everything, or they reduced their positions in risky assets. And as you can see, we have seen also a drop in the holding of EUA derivatives in their case. However, as the market calmed down, there was again an increasing appetite for riskier assets, and they started to build up long positions in the carbon market again. So this is a very interesting development. I have to say also that there is still a debate in the market. It's a chicken-egg question. What is first? So is the market reacting on the data that are released every week on actually Wednesday? And is the price just running after the news? Or is it vice versa? So that when the prices are increasing, then investors are stepping in again. It's a question, I do not think that anybody has the answer on that, but it's really interesting. In general, we can observe quite a volatility after the publication of the data in the Commitment of Traders report. As I mentioned, it appears every Wednesday. And just coming to the upcoming months, let's say, just to provide an outlook, I've brought you this seasonality chart. I help you interpret it. So of course, on the vertical X, you can see the different years, and on the horizontal, the different months. And each cell represents the price change of the benchmark contract from one month to the other. And then the top row represents the average of the last 5 years. So as you can see, January and February, March and April are positive months, but what is interesting is that April has been always a positive month, simply because this is the end of the compliance period for the previous year. In general, one would expect, we also have plenty of clients who say, okay, for next year, I start buying from May, because I suppose that after April, everybody just goes away, forgets about the carbon market, and prices should drop. This is actually not the case, especially not since 2019. Because this was the year when a new reform has been implemented, the Market Stability Reserve, which takes out allowances from the market in order to reduce the surplus from the system. And this means that in general, around mid-May, the European Commission publishes first the surplus number and also the number that will be absorbed from September from the system. In this year, there is something that is extra to that, which means that additional allowances will be auctioned by the European Union. And the question is how the market will react on these announcements. Of course, it is possible that the price falls this year. Thank you very much. This year in June. However, we should keep in mind that the Market Stability Reserve will counterbalance the effect of the Repower EU plan. And therefore, what I've also shown in my second chart, the volatility of the price we have experienced in the past is most likely to remain with us also in the future years. And of course, if we get further in the seasonality chart, we can see that August is also quite an increasing month price-wise, because this is the month when the daily auction volumes are reduced by 50% by the European Commission, and this is the volume that is offered by the European member states. September and October are in general declining months, and in our experience, the explanation for that is that power companies, especially among our clients, the district heating companies, spend their money mainly on purchasing the fuel. And they have to wait until October, November even, to start seeing the revenues from the power sold. And therefore, they do not purchase many allowances. They are not very active in the carbon market. And last but not least, December is generally a positive month, simply because many companies have this internal policy that they have to purchase the allowances covering their current year emissions in the same year when emissions get into the atmosphere. I think this is a quite useful chart, especially for compliance entities planning their strategies on the long run. I also have to say that recently, in this compliance season, talking to companies, we have seen many long clients, which means that companies have a surplus of allowances, of course, especially speaking about industrial clients, because in the last couple of years, especially 21, 22, they experienced already a reduction in their activity levels. This is what they told us, and they also expect 23 and 24 to be challenging, which means that due to the dynamic allocation in the system, there is a certain delay in the reduction of their free allocation. So for last year, they still received plenty of allowances, but right now, as I mentioned before, with the high interest rate environment, it is more favorable for them or more advantageous for them if they sell their surplus allowances in the market. And if you check trading data, for example, from the last couple of weeks, although the price volatility was significant, the volumes remained, let's say, below the average or below what we have experienced in the last couple of years during the compliance season. So this is a quite interesting development. And unfortunately, if we speak about the future and the energy crisis, and what if we are over the energy crisis, I wouldn't say that we have left it behind us. So based on the feedback of our clients, I would say that the next 2 years might be still challenging, especially in the industrial sector. And I come to the last topic, which is the political changes, the reforms of the system. It is a recent development that the European Parliament plenary has just rubber-stamped yesterday the main reforms of the EU ETS. So these changes become law already. Here I highlighted those reforms that are, let's say, the most important from the view of the ETS and the compliance entities. First of all, the cap of the EU ETS. Right now, the cap decreases by a linear reduction factor of 2.2%. However, already from next year, the rate almost doubles, and there will be another increase from 2028. So this will reduce overall the amount of available allowances significantly in the system. And 2 other steps will be implemented in the future. The first one already next year. There have been never similar steps in the EU ETS. First of all, next year 90 million allowances will be taken from the system. This is the called rebasing. And then another 27 million in 2026. Other important development, which is mainly affecting the sectors mentioned on the left-hand side, cement, aluminium, fertilizer, steel, etc., is the implementation of the carbon border adjustment mechanism, which means that importers of these goods will have to pay for the difference of the carbon price they paid in the producing country and the European carbon prices. Of course, if somebody is importing products from a country where there is no price on the carbon content of the products, then they have to buy the whole carbon content, for the whole carbon content of the product. This also implies the gradual reduction of the free allowances these sectors received until now. The original plan of the European Commission was to phase out the free allocation for these sectors in 10 years. But as you can see, the final consensus among Commission, Parliament, and Council of the Member States was to speed up the reduction or the phase out of free allocation until 2034. So this means that by that time, these industrial sectors won't receive any free allowances. Of course, if they keep emitting, they have to turn to the market and purchase allowances. Regarding the MSR, ambition has been kept. The MSR is still taking out 24% of the surplus from the system until the end of the decade. Compared to that, this withdrawal rate would have been reduced to 12% from this year, but the ambition has been kept. And last but not least, there will be other sectors joining the emissions trading system. The shipping sector, the maritime sector, and although it seems that they only represent a small fraction of EU emissions, it is important to know that they won't receive any free allocation, so therefore they will also increase the demand side of the market. And yeah, just sharing with you our views on the carbon price development, let's say short and medium term and long term. I would say, based on what has been said previously by me and also by the analysts speaking before me, I would say that an ambitious price increase has a lower chance to become reality. However, as you can see, even in my bearish scenario calculation, the price is expected to increase towards the end of the decade, especially after the REPowerEU allowances do not hit the market anymore, simply because of the factors that have been just listed before. And I think with that, I have to finish, right? I was running through the slides, sorry.
No worries, no worries. Thank you very much, Brenda. Thank you very much indeed, Brenda. That's a very good overview of all the current drivers there for carbon. So if I understood you correctly, you see carbon consolidating in the 90s, kind of Euro 90s, and then maybe hitting 100 towards the end of the year next year. Would that be an okay summary?
Yes, if we speak about yearly average prices, then yes, I think that we might see prices consolidating around these 90 or 100 euro levels. Of course, with the disclaimer applying that the price volatility is still huge. We do not know how the market reacts once the first REPowerEU EUAs hit the market. There might be an immediate reaction of dropping price to 80 or even lower, but then I expect the price to recover. This is actually what we have also experienced in the past. We have seen shocks coming from outside. We have seen COVID. We have seen the start of the war in Ukraine. In both cases, the price plummeted significantly, but what we have seen in both cases was that the price recovered not just to the levels from where it fell, but to even higher levels. So this is why I think that on the long term, we have to calculate with higher carbon prices.
Yeah, absolutely. Any questions from the floor here? I know there's a coffee break looming, so we have to.
I tried my best to run.
No, you did very well, Bernadette.
I even lost my breath with running through the slides.
I know. I'm sorry about
No
sort of forcing you through, rushing you through. But a final question before the break really is about the role of speculators. You mentioned their investment funds and speculators. Do you now expect the discussions around limiting their role to be over? Do you see that kind of discussion coming back and some pressure onto the Commission to, for example, there were even some discussion about limiting speculation but allowing hedging, or these are all kind of to me very interesting.
Yes, we have
aspects.
seen a couple of proposals from limiting positions or to oblige speculators to hold positions until a certain time period. There have been a couple of ideas. All of them have been rejected by the European Commission. Of course, I think that these kind of suggestions will come up every time we are struggling with a difficult, mainly macroeconomic environment. So we cannot exclude proposals similar to these, although I think that the probability of these kind of interventions to be adopted and approved are very low. I think that the European Commission has emphasized several times that the EU ETS should be, let's say, as a real market as it can be, because it is still an artificial market, and therefore any kind of this interventions. Or in the past, we also had the proposals of a price corridor, a minimum price, maximum price. We have seen plenty of proposals. I think this is the characteristics of an artificial market, that there are always proposals, amendments emerging, but none of them has been adopted by the end of the day. So I think that there will be other rounds of brainstorming by politicians, but I think that the market will stay a market as it can.
Fingers crossed. Thank you once again, Bernard. Here's a little present from us.
Yes, welcome to the panel discussion. I would like to briefly introduce our participants, just so everybody knows who's on stage. We have on my far left, Paul Dawson from RWE Supply and Trading, who joined the company 15 years ago and in total has 3 decades of experience in the energy markets, and he's head of regulatory affairs. Then we have Stefan Göbel at Stadtkraft. He's responsible for the company's wind and solar assets in Germany and Spain. And he's been with the company for over 20 years and also held roles in the energy market prior to that. And next to me is Philipp Pfefferle. He works for BASF Renewables. And the company is responsible for providing BASF, one of the biggest single energy users in Germany, with green power. And to become carbon neutral by 2050. Right. Perfect. So I would like to start with a view from all these experts in the energy market on the proposals of the energy market design from the European Commission, which was published on the 14th of March, an 86-page long document. So maybe, Paul, if you would like to start with how this document was received at your company.
Okay, thank you. Well, overall, I think the best bit about the document that came out was what wasn't in it. So rather than what was in it, and that is the temporary revenue cap on generation. There's no proposals to extend that. There was no proposals to decouple the markets or split the markets into green pools and marginal pricing, and so the fact that the wholesale market has emerged intact, I think, is probably the main positive. There's some other positives in there as well. I mean, the transmission access guarantee will help offshore wind, and the CFDs. I think an endorsement of that as a support mechanism to underwrite the vast amounts of renewable investment, I think, is valuable. I mean, there are some parts that are more negative, and I look here really as, maybe it's a missed opportunity. We're still without an answer on how we're going to build the backup capacity to the wind, how we're going to have firm, flexible capacity, probably CCGTs with hydrogen conversions. A capacity market, I think, is an essential element of that story, and that, doesn't feature. Instead, there are proposals around peak shaving and flexibility, which maybe target part of that need, but don't do so in a particularly holistic way. So negatives there, and I think proposals to develop virtual hubs rather than work to improve existing hubs is also a negative. But maybe leave that there on the positive and negatives. I'm sure we can come back to some of the other topics as well later.
Yeah. Stefan, do you also want to give a brief?
Well, maybe not so much commenting on what the EU has proposed or not proposed, maybe just reflecting on this whole zombie debate on market design. Because, I mean, the market, as we've lived with it for 25 years, I mean, it's just what it describes is actually that it hasn't been designed. It's just free forces of the market, supply and demand finding their way. It's so fundamental, so easy. So don't mess around with it. And I think that has been reflected indeed by any intervention missing in the EU proposal. And I think the consultation was probably helpful to really finding out, okay, I mean, you can try to play around with it from an ideology perspective, but it doesn't help, as we have seen maybe in Spain and other places, and also by attempts to intervene over the last 18 months elsewhere. And maybe that's also important to reflect after 25 years of the market, how well the market has coped with all the challenges, right? I mean, imagine the situation pre-1998. How would you have managed a war on energy in Europe in a pre-1998 scenario? What's that? TSO trying to exchange volumes in that order of magnitude? Redirecting LNG ships by regulators? I mean, trying to stay autonomous in your relatively small supply areas? It wouldn't have worked. We would have lost security supply, would have emitted even more carbon. No way. The market is without any alternative. And I think that is something that we need to maintain. And I think that is basically, at least in Germany, I think that is also consensus. What we see is maybe that on some elements we see investment signals not so strong anymore, particularly on the backup capacity that you mentioned, and also probably on the renewable side, where we see CFDs as the mainstream tool for support next to, of course, PPAs.
Yeah, we will also come to that in a minute. And Philip, how was this reviewed at your company?
So basically, I mean, taking a look at last September, the discussions that we had last September, that was also the date from the last German Energy Day of Montel. So we had quotes from European politicians that said the merit order doesn't work anymore. And where we arrived then in March, we think this is quite a positive proposal, because it seems that people and politicians and all the stakeholders, they have understood that the merit order and the marginal pricing and the current overall market design is working, and that what happened was a result of scarcity and just a sign that has been reflected in the market prices. So in this context, we see that it's quite positive what came out, but still the devil is in the detail as well. And I mean, just talking about one of the details, I mean, mandating two-sided CFDs as the scheme for state support. I know there are many pros and cons with regards to this, but from a power off-taker perspective, and we as a chemical firm, we have quite a large power consumption. We are ready and we are willing to invest. We are ready and willing to sign PPAs. And for these amounts that fall under the two-sided CFDs, we're simply not able to get access to these amounts of green power. And that's what we see a little bit critical, because we say we're here, we are ready, and then we see some instances of regulation where we don't get access to these amounts of renewable power, and where we would like also to be part of the discussion in the next month when they are finalizing the legislation to make that point very clear.
Yeah, thanks. I think the industrial part of things is also becoming a bigger topic also for us at Montel. We always have more customers from the industry. We write more about them. And you told me in the preparation, Philip, that BASF, the plants in Ludwigshafen at the headquarters is like 1%, consuming 1% of the German power per year. And that might double or maybe even triple short term as the electrification goes ahead. So that's quite a big
So it is
yes.
currently, it's around about 6 terawatt hours that we consume at our major site in Ludwigshafen, which is in the southern part of Germany, which is around about 1%. And our overall power demand, because we have a strategy of electrification, of direct electrification, where we use natural gas at the moment, for example, for our crackers, which are at the beginning of the chemical value chain. We want to use renewable power in the future. And exactly this electrification leads to the fact that our power demand will rise a lot over the next decades. So it's rather not short term, but over the next decades, because these projects are huge to come from natural gas to renewable power.
Yeah. I think that's a big question. Where is all the renewable power coming from? And I think the regulation of the European Commission, one of the main targets was to protect consumers from the price swings on the fossil fuel markets, and the longer term contracts from the PPAs and the CFDs are meant to protect the private people, also the industrial customers. But the question is, what's the downside? So does it mean, or what does it mean, I don't want to say downside, but what does it mean, maybe Stefan, also for the expansion of the badly needed expansion of renewable energies in Germany?
Yeah, I mean, intervention is always bad for investors. You want a stable investment framework. You want to understand what you're getting into for the next 20, 30, 35 years. And intervention ex post to take away profits is always a bad idea. Of course, I mean, last year we had an unprecedented situation with a war. So I guess most of the industry was absolutely accepting the fact that there was some excess revenue skimming. Okay, I don't think it was smartly designed. I think a tax would have been easier, but okay. I think as an investor and developer of renewables, we are fine with having both a CFD environment and PPAs. I think we stand better on both legs. We see markets and periods where one or the other has advantages. So we definitely want both instruments to be available for the future.
What's your view on this, Paul?
Well, I think very similar. I think, you know, both have a role to play. I think for the new investment, the CFDs provide an additional layer of protection, and they do help square that circle between, you know, shorter term prices, continuing to drive availability, maintenance, operational decisions, but also the trade-off between firm flexible capacity and intermittent wind. So the market's still got a role there, but you've got that longer term revenue stabilization on both sides provided by the CFD. And the CFD has other elements that help avoid things like winner's curse and the auctions for support and things. So, you know, overall, I don't see it as an alternative, but I think the two can work pretty complementary.
If I may briefly add to that, Paul, I mean, I just mentioned that we're pretty much on the PPA road. Yeah, we're interested to get access to the power. But I would agree to say, well, it's not either or. There are also concepts to combine both of the schemes. For example, looking at Poland, where you have auctions, where you can sell PPAs at the same asset, and you can get access to CFD for other parts of the same asset. And I think this is a good direction because, of course, we see CFDs and support schemes, they are coming and they are being concretely discussed in the power market reform. But also on the other hand side, it's being stressed all the time that PPAs and market-based instruments need to maintain and they need to flourish in the future. So we're really open for these discussions of how to combine both of them and how to make sure that industry gets access via PPAs, but also maybe how to include the aspects of other companies which are more supportive of CFDs.
Yeah, thanks, interesting. There was one more thing when I was looking up this document and the reactions to it. So some people fear that if you bind too much power, physical power in these long-term contracts, it might take away liquidity from the futures markets. So what do you think, Paul, as from the one of the biggest, so very big trading companies. What's your view? Do you think this is a danger that the power that's bound in these contracts might then not be traded on the futures markets, or is there a way to do it?
I mean, there's clearly a trade-off between managing risks in the shorter term versus the longer term. And, you know, more longer term probably means there's less being done shorter term. At the same time, you know, if the CFDs are appropriately designed, that power, that physical power is still coming to market. As I said, you're still getting the market signals to dispatch that power efficiently, to maintain the assets, to turn the assets off when you've got too much wind. You know, so there's still a market signal, there's still playing that optimization role, that shorter term hedging role. And that can help support liquidity for other assets. I mean, you know, if we go 20 years forward and everything's under contract in the long term, then, you know, clearly that's going to have an impact. But I think in the medium term, there's no immediate threat, provided these instruments are designed in a complementary fashion.
Yeah. How about at Stadtkraft, Stefan?
I don't think there would be a major impact with having larger volumes under CFDs. I can't see that. I mean, the CFDs are covering a period of 20 years, give and take, and the market that we are concerned about is covering a period of 1 to 3 years, if we're honest, right? I mean, the market hasn't been so terribly helpful over the last 20 years, at least, when it comes to 20-year periods. I mean, the super long-term PPAs with industry are a relatively recent development, so I don't think that that's really a threat.
Mm-hmm. Yeah. That's good to hear, because what's your view, Philip?
Yeah, I mean, it's exactly the same for PPAs. If you sign a PPA to de-risk an asset to get financing, it's not going to be 3 or 4 years PPAs. It's going to be 10, 12, 15, 20, 25 years PPAs, as they have been signed also over the past years. So I don't see a conflict there between long-term PPAs and the time horizon for the forward markets is simply not that long.
That's great, because the market has been in a crisis recently, and now volumes are coming back, so I'm sure the traders are eager to start trading again, getting the credit lines and finding more partners again to do their trades. So I think, that's what everybody's looking forward to. I would open the floor to questions in a bit, so if anybody wants to ask a question, you can start thinking about it. But I'll give you a little time. We cannot talk about the reforms without looking at the virtual hubs that were recently proposed by Acer. It sort of seems to divide the community, and some fear it might lead to the final, not final, but eventually to the split up, maybe even of the German energy market, the German pricing zone, which is an important zone, the most liquid for futures market and used for hedging. People rely on it. Maybe, Philip, what do people at BASF Renewables think about these virtual hubs and the danger of a split in the pricing zone?
Yeah, so I think two very important topics. I mean, when I talk to our traders, so we have been establishing over the last years like an own power trading, which makes sure that the assets that we invest in or the assets that we currently have already from gas-fired power plants to renewable power at our company, that they are traded and optimized in a good way. And these colleagues don't support the introduction of these virtual hubs. It might take out liquidity, for example, of the German market, and they rather prefer to stick to the way that we have it at the moment when it comes to our trading hubs and trading regions. And I mean, the next question that you connected with it was about the bidding zone setup. And I mean, here having in mind that the industrial base or the majority of the industrial base in Germany is in the southern part. Also, our major plant and a lot of generation capacity is in the north, also looking at the offshore capacity that is being planned to build there. So we somehow have to make sure that the power from the north gets down to the south, and that we have a plannable investment environment, a plannable environment also for power costs. And considering the facts with the generation in the north and the consumption in the south, of course, the price spread will be there. How big the price spread is, I think, is the big question. But we will for sure, as a southern German industry, not benefit from such a power market split, which is why we are rather advocating for putting more focus on the grid build out, making sure that these bottlenecks that they are removed, so we can transport the power from the north to the south, and make sure that we remain the one bidding zone that we currently have, because we think from an overall economic perspective, this is much more helpful than having a discussion about the next very serious intervention that might destroy business cases for industrial factories in the south and for renewable power plants in the north, to rather focus on what we need in terms of infrastructure.
And then all the people who built their wind farms in the north, they would have to sell at a much cheaper price. So
yeah,
what would people at Stadtkraft think of that?
Well, it depends if you have a CFD or not.
Yeah.
Or a PPA.
Or a PPA, true, yeah.
Now, maybe first of all to the virtual hubs. For me, this is also, I don't know where this comes from, because if somebody wanted it, we would have made it, right?
Yeah.
I mean, there have been exchanges around for decades. They're constantly speaking to their clients, and if anybody would want it, they would clearly design such a virtual hub. You can also replicate it by buying a basket of Spain, France, Germany, Belgium. Okay, liquidity is not always great, but you can get a few clips here and there and then build your basket. I don't see a need and a demand for this. I really don't. So, okay, maybe I'm wrong, and then okay, let somebody try it. But also, I don't see why it should be regulated. Yeah. I don't see that. German bidding zones, of course, super interesting, debated for decades, and also, of course, I mean, you can turn it into almost a cultural discussion between the engineers who say it's nodal pricing is the optimum. Yes, of course it's the optimum technically, but I'm not sure if that gives you any liquidity. It doesn't, and it gives you ultimate market power, and you need to regulate everything. And then you have the market purists, maybe like myself in my younger days, saying, "Oh no, Europe needs to be a copper plate." And now we're at a point where the tension inside Germany, both economically, socially and technically, has become so large that there is a real chance for 2, 3, or even 4 bidding zones. And I would like to ask the audience, what do you think? Will we have 2 bidding zones or more in 5 years or not?
Oh, good question. Maybe we should make a hand vote. Who thinks that in 5 years' time Germany will still have a single pricing zone then? Okay, looks about, if the others vote the other way, then looks like 50-50, right? What would you think? The others who thinks there might be a split up? Not so sure.
A lot of people undecided.
And then there are a lot of undecided people.
I'm extremely relieved that it's a minority.
Yeah.
We can broker some bets in the brain.
Yeah. You seem to largely agree, Paul, or is there anything you...
No, I fully agree with everything that's been said. I just find the whole concept quite weird.
Yeah.
You know, we've got existing hubs and bidding zones that are very, very liquid, and we want to invent new ones so we're trying to take the successful trade we do have and put it somewhere else. And the other leg that's missing is this with virtual or financially firm transmission between these hubs. We've actually been trying for the last 20-odd years to get TSOs to sell financially firm transmission across borders in order that you can hedge the basis risk between different physical hubs in a way that brings liquidity from hubs like Germany into the Netherlands, into the Nordics, creates more competition at local zones and local Nordic zones, and they've pretty much refused to. So we have, 3, 4 generations of regulatory change that hasn't been able to solve this problem. And now that's seen as the solution. Cynically, I'd see it as a detraction from the failure to build enough transmission. I think it's solving the real problem here. It's not nodal pricing or the absence of sufficiently granular zones. It's the failure to build enough transmission quickly enough to accommodate the changing investment requirement.
Yeah, certainly a topic in Germany. So we promised some questions. So if there are any questions from the audience at this point, feel free to ask. No, okay, then Isaac, from Montel, my colleague Isaac from Montel.
Thank you. We've been talking a lot about bidding zones, but another topic would be subsidies on power prices. The German industry, energy-intensive industry, is demanding. The EC is against it, as we reported on Montel, and there have been different options that have been debated, from pooling specific industries like the solar industry, which would pay into a fund and in turn get PPAs at a cheaper rate. For instance, what are your views on that? Industry power price, Industriestrompreis. Thank you.
Is that directed to myself? So as a representative of the industry, probably. So I will start and try to share our view on that. First of all, I think it's very interesting to follow the debate and to see the quotes that the German industry is demanding an industry power price. I think we have to view that in a very differentiated way, because I would not say that the German industry wants that. I think different industries, different players, they support different concepts. When it comes to BASF, of course, we are interested in affordable and competitive power prices. The big question and challenge is how to get there. And what we are trying to achieve is to get access via market mechanisms to competitive power prices. We've been investing in an offshore wind farm, which is the largest offshore wind farm in the world. 2 years ago, it's being commissioned this year. So we get access there by doing our own investment and getting access to power at cost. I mean, we've been signing long-term PPAs in the past that give us access to competitive renewable power prices. So there are instruments there, and we think that the main instrument to reduce power prices are not state subsidies or something like that, but rather accelerate the build-out, increase the supply of capacity, and that will reduce the price in a sustainable way. Of course, there might be an intermediary time when interventions are needed, maybe also specifically for industries or companies and so on. But the overall scheme that we support is that accelerate the build out of the power and make sure that thereby the prices are becoming competitive for the German and the European industry.
Yeah. Thank you. The list of the questions I still have on this piece of paper is still long, but in the interest of time, as Richard likes to say, we have to end the discussion here. Thanks a lot for your interesting inputs and sharing these 30 minutes with us.
Thank you very much, Julia, and the panel. Excellent discussion.
Thank you.
Before we move on to the next roundtable, we'll dive deep into the future of energy trading. Are we going to be, are traders going to be taken over by machines? Is there going to be a futures market? So I think to speak of, I think we need the opinions of Fredrik Bodecker, who will talk us through the future of energy trading. The floor is all yours, Fredrik. Fredrik Bodecker, CEO and partner of Bodecker Partners. There you go.
Thank you. Thank you. Okay, and thank you to Montel for inviting me again. I'm always surprised every time I'm allowed to come back, but it's good to be here. This will be, probably this one should have been the first presentation. We've touched upon a few things that I would talk about, but I was relieved that I'm of opposite opinion of a few of the things that we talked about. So hopefully I will give you some ideas and some things to talk about. My shock yesterday was that I saw that I only had 15 minutes. I thought I had 25, so it's been boiled down a little, but let's see how well I will cope with this. Will energy trading ever be the same again? Well, the short answer would be no, and this could be a very short speech. But of course, I'm a 50-plus male, so I need to go to the philosophers. Every good speak should have a philosopher. And you've probably heard of Heraclitus, I think it's called in English. That you cannot step into the same river twice, and everything is moving, and the only thing that's constant is change. And yes, that's true. But if we take a look back, I lived in Düsseldorf and worked for RWE in 2000 to 2004, I mean, and just to see how much things change. This was the most popular song that year, the Las Ketchup, I think they call the Ketchup song. The average internet speed over the world was 127 kilobits per second, so we are 1,000 times faster now. That was an amazing mobile telephone, for those of you who hasn't seen that one before. And that guy there started working for RWE Trading, managing the Nordic trading book. And on his first day, he went up to the risk manager and asked, okay, what are my mandates? What are my risk limits? And the guy said, 3 terawatt hours. Okay, 3 terawatt hours, what product and what liquidity risk? No, 3 Terawattstunden. That was what I could trade at that time. And of course, it was a different world. Daily volatilities were a couple of Norwegian kronas. We traded Norwegian kronas in the Nordic market then. And actually, 22 years ago, just after Eastern, so we are close to that period, I had one of my largest positions ever, not the 3 terawatt hours, but almost. I was long, it was Easter, a long break, and the weather had totally turned around. So I knew on Tuesday morning there will be blood, and it will probably be in my stomach. Of course, the market opened down with a record movement ever, 19 Norwegian kronas, less than 2 euros today. But you can imagine with almost 3 terawatt hours, that's a pretty big move. It kept on going a little, but just imagine having someone today out there with those positions, and it moves 100 euros. So things have changed a lot. But I don't want to be old and boring and looking at philosophers, so I thought, let's go to ChatGPT. What will I talk about? And don't read this, it took a second. And of course, they come up with a fantastic presentation. If I had had this one for you, I think you would have been okay with it. Just go through it. There's some stuff. Germany continues the transition. Energy markets will renewable growth, energy storages, digitalization, artificial intelligence, market integration, and climate change policies. So that would have been a perfect speech, and thank you. I love the conclusion, though. The fundamental principles of supply and demand, risk management, and market dynamics will still apply. So thank God. That's still a job for me, and still a job for all of us here. But so of course, this would have been the perfect speech, and everyone would have been happy. But I realized with 25 minutes that I thought I had, no possibility to go into depth in this. So I thought, let's focus on 2 subjects. So that's what I'm going to do. I'm going to talk about the hydrogen hallelujah. And the picture to the right there is the Roman emperors that you might know, that they had this slave behind them that said, remember you're mortal, memento mori. So we will talk a little about that. The second part is the PPA party, where you see that I probably have a different opinion to some of you here. Possibly the party is over, at least for now. So we talked about the intervention. And sorry for speeding up, but I only have a few minutes left. Government intervention. I would argue that possibly it's too much this time. Revenue caps and all the things we've seen over these years, I totally agree that the market has been fantastic of coping. We've got more and more and more, and we found ways around it. If we look at my main market, the Nordics, liquidity has gone down, but it's still working, but the machine is having a hard time. So I would remind about this figure or this picture that, okay, it might seem that it just can take everything. Just another straw. But sooner or later, the camel's back will break. And I'm a little afraid that we might be close to that. But not only the interventions. If we talk now about the hydrogen hallelujah. So we're not only seeing interventions, we're seeing so much support for hydrogen. EU and America, the IRA, and the new Green Deals, they've decided it's hydrogen we're going to use. So this is the way, or as I would put it, hydrogen is the way. So we are facing these new forces. And I'm an old grumpy man, so of course I'm a little skeptical towards that. If we see the figures, they are amazing. Another 80 gigawatts, that's what we want in the EU, 10 gigawatt of electrolyzers in the UK, 430 billion euros we throw out to build all these electrolyzers. That is a lot of power. Where are we really going to find this? And if it's going to be renewables, let's say with wind power, onshore, offshore, we are talking about maybe, let's say 300 gigawatts of wind or 600 gigawatts of solar. So these are amazing numbers we're talking about. So I'm throwing out that challenge. Where is this power coming from? And how are we going to get there? I would definitely argue that it's impossible. We will never get there to 2030. So we see several analysts that basically assuming that this power will be there, and then we can calculate the prices backwards. But I will definitely take this with a pinch of salt. I don't think this is possible. There are other implications which I think are quite interesting. If we have a certain amount of electrolyzers, then let's say the variable power that we've been coping with, or that we have a hard time coping with, especially, or let's say in the north of Sweden now, with all the new wind, we will be able to regulate that with electrolyzers. But if we build another 300 megawatt of wind, will the electrolyzers catch up, and how are we going to cope with that? So that's a discussion I will be glad to have tonight at the boat trip with all of you. I'm not sure it will, and I'm a big fan of batteries that you probably know, some of you. Another interesting thought I want to throw in here is all these new renewables to cope with all those electrolyzers that we are supposed to build. How would that be nominated? We're talking about the weather risk. It's a new situation, the weather is there, you just have to take all the wind and all the solar that is coming. But if I look now at the north of Sweden with severe cannibalization, where the wind farms only capture 70, 65, 55% of the power price in certain months. So a terrible situation for many of those players up there. And we see more and more of them becoming quite large. So several of these infrastructure funds have now bought quite a lot. So they are gone from being small investors buying one wind park here and one park there to becoming quite powerful, like the regular energy companies. So just assume that if you know tomorrow you're going to produce 4,000 megawatts of wind, and you know that everyone else in that area will produce 4,000 megawatts of wind, why not nominate 2,000 instead and curtail the rest? And my thesis here and the early analysis shows that the power price will be so much higher without this wind that they will recoup the lost 50% that you're curtailing or using for something else. So that's another idea throwing out to you. Will these large players start to act like traders? And before someone says that that's market manipulation, I would just like to remind you that the Norwegian and Swedish hydro producers have been doing this for 100 years with their water. So I think it could be done with wind and solar also. So, but the challenge, of course, with these amazing figures that we see, the hundreds of gigawatts and the hundreds of terawatts from the new industries that are moving to power to X and using hydrogen instead of gas. It's very hard for us to forecast it because it's so almost digital. Huge elephants that either go for 6 or 10 terawatts, or the Swedish hybrid project, 80 terawatts. What if that elephant dies or not? It's 80 terawatts into the forecast, very hard. And same thing with the production. Are they really going to build all these wind farms? And in the middle here, this nice little elephant with the TSOs that move very, very slow. But we have the fast movers with inflexibility and the storage. So super interesting future that we are looking to. So let's go to the second part, the PPA party. Well, admittedly, 70% of the revenues at Bodica Partners are within PPA advisory at the moment. We started our business trying to promote, let's say, more traditional risk management, doing like the energy companies have been doing, using standard contracts. But we soon realized that the lenders, the banks, they forced the wind power investors to have a PPA in place. To have 100% pay as produced, to have 70% monthly profile PPAs. It's gone down, so typically 50% was okay. And now most of the work we are doing is trying to fix all this because it's a terrible situation for many of those wind farm owners up there because they have a PPA and the hours where they aren't producing and they're supposed to deliver, that was okay when it was 30 euros or 40 euros and you would win some, you would lose some. But if you need to buy back your production to deliver on your PPA and the prices are 300, those hours you don't produce, it turns red pretty quick. And that's the situation we see now in the Nordics, and I expect that we will see it also in other areas. So I would like to ask a lot of people to reconsider this. PPAs, we have talked a lot about them, and now the CFDs are coming there. But when you lock in yourself for 10 or 15 or 20 years, it is very hard to anticipate everything that can happen, as we've seen. So, as I said, what we saw many years ago, or several years ago, during the financial crisis, I would argue that it was the banks, that their excessive risk-taking, that caused all the restraints for the energy traders, all the EMIRs and the MIFIDs and the remits and all the challenges that we had that have kind of, I wouldn't say killed, but it made life quite hard. And ironically, it was the banks that profited most of it, because several of the smaller trading houses had to close down, or they had to use the banks to get market access. And as I said before there, the banks didn't stop there. The banks forced the wind park investors to have PPAs in place. It was okay as long as it was pay as produced, but once it went into monthly fixed price profiles or even flat yearly profiles, the trouble started, and that's where we are now. So that is, let's say, my prediction now, that I don't think that we will see the hallelujah moment, at least not in the Nordics. I've seen that before already now, regarding the PPAs. They are hesitant. It could be just because the price levels, they are pretty far from each other, the buyers and the sellers, but it could be also that the wind park owners have realized that this is going to be tough. But just a short recap, or it needs to be fast. PPAs were fantastic because you could lock in a long-term price, you supported renewable energy by the additionality concept, you could customize it and make it very special, lower credit often, because there was such a high credit demand after the financial crisis when you traded financial contracts, and there were all the support schemes. But I would say they were also very terrible, as I mentioned. The pay-as-produced were okay, but then the Statkraft and the Expos and the Centricas and the others that sold these PPAs, they realized, or they bought the pay-as-produced PPAs, they realized, oh, shit, we have a lot of risk here. It became very expensive to them. So either the premium or the negative premium on the pay-as-produced have been so large, so it's very, it's not very, let's say, profitable for the wind park. Or they started doing the monthly profiles again, or instead. And we've seen that this cannibalization effect are really hitting them heavily. They are super complex. Now when we are trying to renegotiate them, and of course the lawyers, fantastic lawyers that have made these 10-year deals or 15-year deals or 20-year deals, trying to cope everything that can happen over 20 years. So 120 pages contracts are not uncommon, and trying to amend them or renegotiate them or fix them when something like when the Ukraine war happens or something like that is very hard. And yeah, as I argued, you cannot anticipate what would happen. The black swans, it could be a COVID, it could be a war. It's very hard to anticipate that. So what I will argue, I'll steal 4 more minutes, is that you cannot have something as rigid and complicated as the PPAs. You need to go back to the basic building blocks. And I would say both in Sweden and Norway has been quite successful in focusing on very simple stuff. The Lego blocks, or for those that you have younger kids, the Minecraft, where you basically have very small blocks where you can build and invent everything and handle everything. I say back to the basics. So I would say, look away from the very long-term rigid PPA contracts with 120 pages and go back to use financial contracts again. I know that there is a low liquidity, but that is kind of what we are assuming, and that we need PPA because there's low liquidity. We talked about the chicken and the egg before, some speaker here, and I would say, let's start to fix the liquidity instead and start using the financial markets. We already see those signs among some of our clients now that have become experienced in energy trading, and they're starting to use this. And yes, you could have a physical long-term contract if you want to have all the follow all the policies to get the green benefits and all that. You could actually have a shorter term or a longer term physical delivery. You could call that a PPA if you want, the physical part, but make sure it's floating. so that the fixed part is managed by financial contracts. Basic building blocks. So few slides left. So I would say, to conclude here, there are financial contracts on the exchanges. They are listed, and you can do them OTC. Even if you can't do a monthly PPA for 2029, you could find a player that offers it, or you need to use your Lego and Minecraft skills to find how it correlates and use that intelligence, which players have been doing in this market for 25 years. So I would say we should stop promoting the PPAs and instead try to fix the credit part. That's the last thing that I don't really have a good solution for, and start using the financial contracts instead. Well, that's, let's say, my message, but I also understand that I'm probably pretty alone in that fight. Everyone wants to have the PPAs, and I'm sure that this hangover we see now, that will be forgotten soon. So everyone will jump into them again. There is such much support behind them from governments and also the banks, I would say. But so to conclude, I'm worried about these things. Government intervention, that's, we had several other speakers that I totally agree with. This Green Deal, the IRA, and the hydrogen hype, what is it going to do with our market? How hard, it will be super hard to forecast when we have the elephants moving as they do, and all the politics around that. I won't go into the CFDs, I think there's not enough time, but I'm not super positive around it, because on the contrary there, think we are removing a lot of liquidity that is necessary in the financial markets. And also it would be interesting to have super large trading facilities at the government if they're going to take one of the sites here in the market, and how they're going to manage that. I'm very happy, and I think that there will be a lot of more renewable players in the revenue risk management area. We are seeing that now. It's not only PPAs, or it's PPAs for 10 or 20%, and the rest they will manage like it was done in the old days by good trading and risk management and financial contracts. Storage and flexibility, I think someone will speak about batteries later, but I think we would be very surprised about not only lithium-ion, but all the storage technologies. And then the flexibility possibilities, when that come in, I think they will win the race rather than electrolyzers and other solutions. So, basic building blocks, keep to that. And I thought, what can be more basic and more restricted than the Japanese haiku poem? It's 3 rows, 17, let's say, phonetic words. It's 577 in those rows. So I asked ChatGPT again, write a haiku about the German energy market and include PPA. I think this is pretty good. German winds blow strong, PPA steady the course, sunrise on wind change. So that's pretty good. And I just had to do another one. Write a haiku about the German energy market, include PPA and nuclear power. And then we will see on what side ChatGPT is on. Nuclear sunsets, PPA guides the wind's dance, Germany transforms. Thank you.
Fantastic. Thank you, Frederick. Certainly very thought-provoking, fruitful thought there. I just want to ask you one question before I turn to my colleague and we pass over to the panel discussion. But so you clearly stated the plans, the ambitions for hydrogen or electrolyzer capacity by 2030 are unachievable. What do you think is feasible by 2030 in terms of electrolyzer capacity?
Well, yeah, I would say 10 to 20% of those targets. I saw a statement from, maybe it was Michael Liebreich or what is called Barnard, that there are 30% of these projects that make sense, and there are 30% that are absolutely stupid, bordering to fraud, and unfortunately 10% of both will be realized. And I think there's a lot of truth in that.
I mean, certainly there's a huge pipeline, but the actual FIDs or final, are still several lacking.
Yes, and I'm a strong believer in S-curves. Otherwise, I wouldn't be so positive about the batteries and the storages. But it is different technologies, and it's competing with building all that solar, building all that offshore wind, and all that capital and all those technologies and all those people that are supposed to build all that wind and solar and expanding all the grid, they are also supposed to build the electrolyzers. So we are competing over human resources here, and I think that's going to be tough.
Well, please stay on the stage, Frederick, and I'll pass over to my colleague Nathan, and I'll also ask Jörg Selbach-Röntgen to come to the stage. And Nathan, all yours.
Thank you, Richard. Can you all hear me clearly?
Thanks. Good to meet you.
Yes, joining me on stage is Jörg Selbach-Röntgen, CEO of MET Germany, an energy consultancy. Prior to joining MET, Jörg acquired 11 years' experience at a leading German gas wholesaler, where he was responsible for large industrial and municipal companies. I think it's interesting here that we're going to be bringing on stage so we're looking at the future of energy trading from here, and we've got the power perspective from Frederick, and I'll be bringing in the gas perspective here from Jörg. I thought it would be good to set the scene a little bit, Jörg, but maybe you could just lay out the characteristics here for us of the difference between an energy system that used to get its gas from Russian pipelines and now gets its marginal gas, I suppose, from LNG. I mean, I can already think of a few differences, but what is fundamentally different about replacing these molecules with those molecules?
Thank you, Nathan. How much time do we have for this matter?
Oh yeah, we're running hard up against the lunch break, so
well,
we'll try and keep this discussion around 15 minutes, and it'd be great if I could squeeze in some questions from the audience at the end, so I'll kind of flag that at the 5-minute to break mark. But yeah, lay out those differences for me.
Sure. So maybe let me give you a bit of a context from last year. We were invited to travel with the ministry to Qatar, which then didn't work out because the plane was too small. So we met the ministry a few weeks later in Berlin, and while we appreciated the effort to now build the infrastructure, which is obviously needed, and we're kind of late with that, or doing that, we also tried to explain that there is no magic hand going to be there in order to bring LNG to the country. And we looked into a few faces with not much understanding the situation. So we said, look, none of my or our big customers, be it the big Stadtwerke, be it especially the big industrials, can or will buy LNG on their own. It's just not feasible. A, because the minimum contract size is just far too large for them. B, it's exotic in terms of the nature of the index, the collaterals needed, the duration of the contract, and so forth. So I said, if we don't organize this properly, we'll not get anywhere besides building the infrastructure. And I'm trying to support as much as possible. So we've got to build the bridge between the producers and the off-takers, and that can only be us and some other big wholesalers that are active in the LNG business. So I actually thought and hoped we could get to a point in last year already signing the first contracts. We didn't get anywhere, but, seeing the infrastructure being built. And I'm not pointing fingers, I'm not blaming the politicians. It's a lot for them to deal with. But we started reaching out to the off-takers in just bilateral discussions, and we gathered a lot of interest. A lot of questions have been raised. But again, all were were a bit tentative and shying away from signing anything. And so we started signing MOUs. We, in the meantime, have, I think, 180 terawatt hours as signed MOUs behind us. So the biggest industrials, the biggest Stadtwerke, but also tiny ones with just 60. Sorry, I mean, not trying to be arrogant, but 60 gigs for us is rather small from an industrial. Signed those MOUs, and they're all waiting. So what needs to happen now is to really give them comfort in terms of, planning base, because on the one hand, you see the government not wanting contracts more than 10, 15 years. Even that's a stretch for them. At the same time, we have to talk to producers, obviously wanting 20-year contracts for the investment decisions for the fields that they have to explore. And I really can underscore everything that Mr. Schröder said earlier. What also needs to be understood is that there is not a lot of LNG right now, and we are in competition with Asia particularly, just as we heard earlier. So we were fighting the lack of molecules, right? The security of supply question on the one hand, but as maybe we got lucky over winter and storages are rather full now, maybe it's not a question of molecules, but it's still a big question around prices. And as long as we're only relying on spot cargoes and don't manage to sign the first long-term contracts with somebody, it's going to not have the effect on the price level that we see currently. That's our understanding. And one last thought to that, mostly 95% of the off-takers that gathered behind us wanting LNG want American LNG. And I'm not saying that's right or wrong, but I can tell you, because Henry Hub was mentioned earlier, that the belief, and I'll call it a renaissance of a long-term contract, that the belief in Henry Hub being the most, let's say, liquid and also the most stable region will lead to us having to find a solution with American producers for some type of contract. And again, we're talking to the government saying, it can't just be us or somebody else from the big ones, that you hope we sign the contract and take all the risk on ourselves if you don't clearly say you will allow those 20-year contracts. And all of the big industrials have the same issues. They might internally have said we're going to be climate neutral in 2035, for example. So we need to all organize this, and it's not a small feat, or not a small task, sorry.
And just to push back here a bit, because I mean it has been brought up in the media. We have heard in recent months that, yeah, there is this discrepancy between what European customers looking for LNG are prepared to commit to because of climate concerns, the impact of climate legislation. We're meant to get out of gas eventually too, of course. And on the other hand, producers' natural concerns for secure revenue streams. Especially if they have to justify new investments. On the other hand, I mean, I hear you say that Europeans aren't signing enough deals, but we see, you know, gas prices have come down so far. Ultimately, why does this matter?
Well, it's true. We call it, at least behind the scenes, a bit of a COVID effect. Now, everyone has its own opinion about COVID and, you know, what we all experience. But what we mean by that is it's a false sense of security. And we don't believe that the crisis is over. We still see volatility, very much so. We are afraid of prices rising within the next months to maybe even 3-digit numbers. That is feasible. It can happen. And it's not to just, you know, scare people, but it's still out there. And I think one big step to mitigate that is to make sure that you have a plannable basis, at least for a certain portion of a portfolio, you have a long-term contract with LNG, but that, first of all, needs to be negotiated. And we're not there yet, not by far. I think it'll take at least until Q3 before, not just us, I'd be happy if I could see some other projects like that, because we need a lot more. Our, you know, off-takers want between 10 to 30% of LNG in their portfolio, just as a rough number. And so even if we materialize a lot of those MOUs, that's by far not enough for the German market. It just isn't. And only if we have those long-term contracts, I think we'll have a bit more stability in terms of price levels.
Perhaps I see things too naively. Can't we just rely on portfolio players and the spot market? Let them be the middleman and sort us out. I mean, either the LNG market is going to be long or short, and we can't really change the fact if it's short. So,
yeah, absolutely true. But talking to all majors, I can tell you that none of them is just picking up a 20-year contract just like that, while you can still assign the contract to, let's say, Japan or South Korea in 10 years from now. It's not something that you just do within a matter of a few days or weeks. And also, one thing that the government did understand in the meantime, the LNG market, as it's global, is very nice for traders to optimize things, right? So you book a capacity, but you don't have to use it, right? Now, that wouldn't help Germany realistically, because you need to make sure that it's actually coming to where it's needed, right, in terms of security of supply. And I think we will see some things, some demands from the government that this is actually being utilized. And we're in really good, you know, communication with, let's say, the Deutsche Terminal GmbH, for example. They all understand this.
I'll try to draw you in now, Frederick, because you've been patiently waiting on the side there. I thought it would be interesting to pick up a little bit on where you kind of left off your presentation. maybe you can tease out for me why this is the case. I mean, we're seeing growing interest in the European Commission, the German government, specifically by the Greens. They're very enthusiastic for the whole concept of contracts for difference in the power market to grow renewable energy. Superficially, I can see it seems attractive to me. You've got prices that can be guaranteed that satisfy two parties on a deal, satisfies the needs of consumers and producers. I would also be very happy to lock in a price for 10 years with my utility. Is there a tension here? Because on the other hand, I hear from the European Federation of Energy Traders, they're very, very critical of this system and see it as a threat to markets. So, is there a tension here between CFDs and the preferred method of just letting markets go and develop their own power purchase agreements and building out the capacity that way? Is there a tension?
Yeah, I definitely think so. It's because I think that it will drain a lot of liquidity. But then I'm turning that argument, or the argument that there is no liquidity out there in the long term, so we are not draining it. But that I'm assuming that instead of doing PPAs or CFDs, we need to start doing the long-term financial contracts instead. Because if you have a buyer and you have a seller, instead of bringing a bus with lawyers to write a PPA, put them at the table and let them do the 10-year forward curve on EEX or ICE or wherever you find that 10-year forward curve on power. So they are on both sides. You can construct the same risk profile as a PPA, but with a lot of less of the complexity. So that's where I see the tension. That's less what's called complexity. But with that said, I think we will have both worlds.
Okay. If I may add a second angle to the PPA discussion, because I really appreciated the view and also the hydrogen topic. If you want to combine the two topics, PPAs are super important for hydrogen production, obviously, and what people tend to forget is the amount of power that you need for the production with an electrolyzer, right, of hydrogen. So just to give a real-life example, we've been pushing hydrogen term sheets last year in summer, and we've been actively trying to market hydrogen in rather small volumes, let's say 20 gigs, 30 gigs, and so forth, for the first, let's say, test candidates from 25 onwards. And we were offering prices in July and August of last year below the past gas prices at that time. So I can even tell it's roughly about 200 euros per megawatt hour. But we were demanding a 15-year offtake. Now, we all know how much there is a hype around hydrogen, and I'm fully for it. I'm not against it, by all means. But guess what? How many offtakers did sign such a... It's a hydrogen PPA, if you want. So just take a guess. How many companies signed? You're right, absolutely no one. And that was a big surprise, because on the one hand, we try to be a bit of a missionary, trying to push the future, right? And we really mean it. At the same time, none of the industrials, none of the big Stadtwerke said, okay, we're going to sign. Why? Because they said, no, it feels too expensive to us. I said, well, just a simple calculation. How much power do we need? What's your estimated PPA price that you assume that we can have underlying the production? How much of an investment do we have over the course of 15 years? How much of maintenance do we have? And would you allow us a bit of gross margin as well? Right? And you just don't get anywhere near the prices that have been, communicated out there. And so coming back to the PPA, what might have to happen is also be more volatile in terms of the power that you use for the electrolyzer, because given the current price levels for PPA, you'll get nowhere in terms of interesting green hydrogen prices. And last comment, that's the most disturbing thing to me, and we've been talking a lot to Berlin and the ministry and people there. They already talk about lock-in effects in terms of LNG capacities, right? While we just heard that there is no long-term contracts yet. So it's a bit of an absurdity to me. And secondly, They already talk about what the flavor of the month is, and politically nice is green hydrogen. Now, hydrogen is scarce. It's going to remain scarce for the next 5 years. I fully agree. We need to do a lot more, and really nobody is talking about the effect price-wise that this will have, because it's not going to be cheap. And that's okay, but you have to admit it, and you have to openly debate it. And if we talk about being competitive as a industry, as a country, then this belongs into the discussion. It needs to be, said out loud, but no politician, to my understanding, is really saying that.
Yeah, it seems to be assumed, well, by some politicians when they seem to be indicating that it's going to be pumped into people's households as a source of heating. It seems like it's completely missing what the likely cost of this energy will be.
And also there would, what counterparts want to go into a deal for 15 or 20 years in the world we are seeing now, where things are changing every week or every hour, and then lock yourself in for that long time. So I totally agree that we see the same thing, that our industrials, off-takers, they don't, and these new hydrogen projects, 2 years ago, 1.5 years ago, they were facing, in the Nordics, sub 30 euro per megawatt hour, 10-year PPAs, and now they're looking at 60. So all those fantastic business cases, they are out the window, and they are really reluctant to recalculate them and meet up there. Yeah, when are we getting closer to each other? I don't know, but it's not looking very positive at the moment. Well, I think we need shorter time spans.
I find it interesting that there is so much political interest now in sourcing long-term agreements, not just, we talk about the power in a way, in a sense trying to manage price risk, but also in the gas market. It was only a few years ago that the European Commission was trying to telegraph to everyone, we don't like long-term agreements, we want to head more towards the spot, but perhaps that was the partner of the time that we didn't want long-term agreements with. And now we're looking more at trying to manage our way into this kind of long-term agreement world that secures, tries to manage away risk. But I'm wondering here if the interventions that sort of began, especially in the wake of the crisis last year, if we don't risk setting off a cascade of interventions that end up shattering the system that we have. I got the sense of that from your presentation, Frederick, but yeah, am I being too negative here, seeing this risk of cascading interventions utterly changing the markets that we have in the next 5-10 years?
Yes, as someone said before, that don't mess with the market, get off, leave us alone. We've heard that before. These fixes on the fixes, it feels like the Finnish people have this saying that you shouldn't piss in your pants when it's cold outside, because it will be very much colder later. And so fixing this now because we are freezing, then yeah. It will be trouble. It will be cold.
One of the things that one of the other unforeseen consequences of the whole energy crisis was perhaps the exacerbation of the inflationary environment we're in, which is completely different to the situation we were in last decade. How much has this kind of changed the trading environment we're in? Because, of course, renewable energy is very capital intensive. Now we've got the price of money suddenly becoming an issue. Is this already affecting the market?
If I may, interest rates is one thing, just the pure credit worthiness, the rating, the credit lines that are needed as an industrial/utility, the Stadtwerke segment, I think that's what it comes down to. For the next 12 to 24 months, we have to reinvent products, we have to reinvent how trading is being done. Look at the OTC market, how it has been. That was so scarce. We've been one of the few that was actually offering products OTC. We see 1/3 of the German GDP being as collaterals placed at the exchange. Just imagine how much money that is. And if you look at the peak price developments in what was it, August last year, summer, power peak, That was one weekend I'll never forget, because we weren't sure if the first big ones were going to fail the week afterwards, because, you know, overnight the mechanisms at the exchange changed. So I think Stadtwerke, industrials, are desperately looking for counterparties. They need credit lines and products that were there to shift risks to, let's say, suppliers that gladly took them back in the day. Those products are not there anymore. At the same time, the Stadtwerke have now to make a judgment call on when to, you know, at least hedge certain quantities for the next, you know, years to come. But that's only one part. How do you price in flexibility? How do you price in the cost, you know, the structure cost of a profile? Is it as it was €1 or 2, or shall we take 30 euros because you just don't know? And it's just a pure bet. So what needs to happen is really a lot of, you know, advice to be given to that segment. And so it's not just the interest rates, it's really risk management, and that's the 100% topic for the next 24 months.
I'm afraid I'll have to wrap it up here. I'm happy to keep on delving into that subject, but I've managed to take us over time, and I realize we all want to get to lunch. So if you've got any pressing questions, I encourage you to approach our panelists at the lunch break. Thank you very much to the both of you for taking time out to talk to us today.
From discussing this morning various commodity markets and diving into market reform and the future of energy trading, we now turn to the industrial sections, which is, we'll start us off looking at how German industry can wean itself off gas, and then we'll be looking at two specific case studies, two industrial firms, and then we'll round off this session by looking at corporate PPAs and maybe a different perspective what we've already heard. But to start us off is our old friend Trevor Sikorsky from Energy Aspects, gas specialist, and who's spoken here many times before. So, Trevor, the floor is all yours.
Thank you very much. And I guess
that's the one. Yeah.
That's the one. It's always good to be back. So thank you very much to Montel for the invitation. Richard did say, I kind of put it out as how can Germany wean itself off? But of course, these are all integrated markets. And so I've kind of broadened that out a little bit to how can Europe wean itself off gas? And we will just start with a little bit of scene setting. But of course, this is stuff you've already seen, we've already talked about today. And that's why do we want to get ourselves off of gas? And of course, there's the climate component, but there's also what happened, of course, in 2022 with what's happened to fossil fuel prices. And certainly all of that, of course, came out of this massive, massive reduction in Russian gas supply into the European market, right? And when you look at it, it's about, we will be down this year about 155 billion cubic meters of gas. That's an enormous supply shock both to the global gas market and, of course, to the European gas market. And the really incredible thing is how quickly the market kind of sorted itself out. And yes, you know, if you look at that, we're certainly a bit bullish, and, you know, the crisis isn't fully over. But it's remarkable how resilient the markets have been. But the response, the immediate response of European policymakers to this was very much, let's get rid of fossil fuels, right? It was a doubling down on all of the rhetoric around transition and on all the policy around transition. Now, the interesting thing is the things that have been voted in since that happened are all very, very aggressive in terms of decarbonization, how, you know, and the speed with which we get there, and the speed with which we will need to move away from gas to something else. Now, the interesting thing is we've just agreed, or it had been agreed, but certainly been discussed for a while, this changed to what's called the linear reduction factor, or LRF. I'm sure all of you know what the LRF is, and certainly Bernadette talked about it a little bit this morning. But if you extend that, and that's the default policy at the moment, so written into European law was you would continue the LRF that takes us out to 2030. If you continue that, you get to not a net zero, but an absolute zero cap for the ETS in 2040. So it's not a 2050 issue for European industry and European power. it becomes a 2040 issue. And that, if you think 2050 was difficult, well, 2040 is even that much more hard. And certainly, you know, they are going to talk about that linear reduction factor, and it's a possibility. It maybe gets extended a bit. Maybe we would think 2045 would be the latest, probably, for the first traded sectors, the stationary sectors, to have that net zero cap. But that is talking about a very, very hard regulation that will drive decarbonization, and will have to drive some form of decarbonization, right? So that's the kind of key thing. We already have that baked into legislation. So we are and will be kind of replacing, you know, gas as we go forward. And certainly when you saw REPowerEU, which was the immediate policy response, that specifically had in it the replacement of Russian gas by 2027 as its target. And you can see what they're going to want to spend on, and they want to spend a lot on a whole bunch of different things, but they want to get about 600 gigawatts of solar installed under our REPowerEU, up from a target of 420. 420 was already exceptionally hard, right? And now it's up to about 600. And a lot of that, of course, rooftop solar, so behind the meter solar. So will probably show up really as reductions in power demand. You know, so it is quite interesting how they're kind of looking at it and how they're kind of thinking about it. And the other thing, of course, that they want to spend on are a lot of things that were, you know, integral, I would say, to Fit for 55. So spending on heat pumps, which would be replacing gas, of course, in domestic heating, and spending, of course, on everyone's favorite green hydrogen. Now, we've heard lots about green hydrogen today. I would say it is one of the decarbonization pathways, and it's part of the decarbonization pathway. It's not the only decarbonization pathway you're going to see, and certainly we've just taken three places where gas goes in at the moment and kind of said, well, what are the major decarbonization pathways we're looking at, and what do they involve? Now, if you look at steel production, we're dominated by basically blast furnace type technology in Europe. But the technology to decarbonize that already exists and is already commercialized. So that's an electric arc furnace. Most of the steel that's produced in North America is done through electric arc furnaces with direct reduced iron. Now, direct reduced iron at the moment is fed by natural gas, so the component that's a little bit different in doing that, of course, is you stick hydrogen where that natural gas would be. So hydrogen does show up there, right? But it's not the only thing that's going to, is going to drive decarbonization, because we have decarbonization in a lot of other sectors. So to think about cement's another one. But cement's bitty. It's not like steel where you say, well, that looks like the winning technology, and that winning technology involves a lot of power and a bit of hydrogen, but it's a bunch of other stuff. So it's a bunch of carbon capture and storage. It's a bunch of clinker substitution. Some of it is alternative fuels. That's probably hydrogen or possibly biomass. And if you were to look at pulp and paper, a lot of that is more like biomass, maybe biomass with carbon capture and storage. So there's all of these different decarbonization pathways, which will involve kind of replacing gas and how in various things that we use gas for at the moment. Now, one of the other, really important bits, of course, is gas goes into power. We kind of know what the decarbonization pathway is on that, but also into space heating, and that's a real kind of challenging bit. But it is kind of seems like the emerging technologies for that is heat pumps, which uses a bit of electric power, not that heavy on electric power, and a bit of environmental energy. It kind of sucks heat out of the atmosphere. It's quite cool technology, but you can't use it elsewhere, or direct electric boilers, and those are getting a bit more efficient, and people are kind of looking at that. So when you look at, how do we get rid of, let's say, gas used in domestic heating, which is one of the biggest uses of gas in Europe, the answer is things that involve electricity, probably. So what you're looking at is gas, which is the massive seasonal shape. As you all know, we use a lot more in the winter than we do in the summer. You're going to take that you're going to take that demand shape, and you're going to put it into power, and that's certainly a difficulty. so a lot of power, and that's probably it. You know, almost all of the decarbonization pathways, even things that don't use gas at the moment, like transport, you're going to say, well, actually, we're going to electrify those. That's the way we're going to do this stuff. Now, this is kind of expensive, and this isn't maybe the best slide to explain it, but certainly hydrogen's not cheap at the moment, right? But you are looking at a technology, particularly in terms of electrolysis, which is brand new, and it really hasn't been commercialized. So you are looking at being at the very top, or at the very high level of the cost curve, and what you want, of course, get is you want to get the same type of economies of scale that we've seen, let's say, in the renewables. You know, if you go back 15 years on renewables are incredibly expensive. Now they're more than competitive against fossils. And that just shows, that graph kind of there is just showing you, the kind of cost, let's say, for green hydrogen. Now, to put it in context, the cost of grey hydrogen, we do produce hydrogen at the moment, and use it in a number of industrial processes, is $1 to $2, right? So here you're looking at things which is kind of 2 or 3 times more expensive. So it becomes very hard to kind of convince people at the moment that hydrogen's going to be great as a fuel, because it is just starting out, right? So subsidy is going to be massively, massively important. You are going to have to subsidize this stuff to get hydrogen and get it working and operating. Now, of course, we do think, you will get, there is a lot of subsidization out there, and you will get electrolyzers being built and used. Now, of course, that has an enormous impact, as we've heard already today. That has an enormous impact on power demand. And it's one of probably the places where you would say power demand is going to really, really, really benefit from. Now, we did talk a little bit about CCS as well as being another component, and that other component, again, is really expensive. And CCS prices, certainly carbon capture and storage prices, depend on a lot of things, as do hydrogen costs. But again, that can be reasonably expensive. And unlike hydrogen, where actually you can use it to produce something, and that thing you're producing is going to have revenue and help you pay for that, with CCS, all you're doing is taking carbon out and storing it. It has no real revenue attached to it. Yes, there is some use for CO2, but that is pretty limited, and it depends on a lot of things, right? And you basically say, well, CCS really only works if you put it in together with a hub, so you share a lot of the infrastructure together, and if you share a lot of the infrastructure together, of course, the unit costs come down. And also, CCS works best if you have a very, very concentrated CO2 stream that you can capture, right? So something like ammonia production, which gives you a very concentrated CO2 stream, is at the bottom of that. And if you look at, let's say, on a coal-fired power station, where you have a much thinner kind of stream, then of course the unit costs get higher and higher. But if you kind of look at that, it tells you what the CO2 price will need to be, because the only reason you do carbon capture and storage, of course, is if there's a carbon price that's paying you for taking that carbon out of the air and putting it into storage. So the EU ETS becomes this very, very important indicator, because if you're going to if you are going to apply CCS into, let's say, cement plant production or in blue hydrogen production, then of course you are going to need that CO2 kind of uplift to really help you make that competitive and take you anywhere there. Now, interestingly, when you look at both CCUS, and I would say hydrogen as well, they both will have kind of a niche, to fill into replacing gas. It isn't going to be the main thing. Probably direct electricity will be the main thing, but certainly they will have places to play. And certainly, I think there's about 72 CCUS projects at the moment. I think 5 of them in Germany, so just a few. It's not really heavy in Germany, that use of CCUS. But they're in various stages of development, and again, rely on an enormous amount of subsidization to make it work. But you can kind of see, where it's going. And certainly there's a bunch which are multi-industry. There's a bunch for blue hydrogen production. That tends to be because that's Europe as a whole. That tends to be places where they have pretty good or reasonable storage. So Norway and the UK, probably two of those, maybe the Netherlands as well. But a few into cement, and then you get into just very little bits as you're going in further and into other activities. But those are kind of the niches that you would expect to see in terms of that technology coming into the market. So it's not going to be that widespread, but it will be important and it will be used. Now, what does that actually mean? And so this is out to 2040, and you can see in terms of European power demand, of course, what it means is, even with, I'd say modest assumptions on a number of these things, you see transition means and this replacement of gas is going to push all of that energy demand into power. So power becomes almost everything. It becomes the primary source of energy in almost everything we do under the transition. It becomes incredibly important, right? And it grows, and it grows, and grows. And of course, what that means is you can add a lot of renewables, but you're trying to chase a demand which is also continuously growing. And that was one of the points made this morning. You build some hydrogen, well, you've got to build an awful lot of renewable energy to make that green, to make that happen. So you can throw a lot of you can throw a lot of renewables there, and I think we're assuming an average annual of something like 70 to 80 gigawatts of new renewables between now and 2040. To put that into context, we added about 55 last year, and that was a record. So it's fairly aggressive, but probably doable. But what that means, of course, is you have still, when we get to 2040, the European power supply with a fair amount coming from natural gas, right? And we will need that natural gas for a number of reasons, but that's because, and you can see in terms of European gas demand, even if we take out almost all of the demand from industry in the residential and commercial sector, you would still have that big green bar going into the power sector, because what we're doing is we're just pushing so much energy demand away from gas and putting it into power that you still need gas around to help meet that power demand. Now, you can see in terms of those power balances, we compared them with 2022, the amount of additional capacity or amount of generation we expect to come from renewables, massively big. A little bit from a tiny little bit from nuclear, but you are asking it to do an enormous amount of things. So you're asking it to fill in for coal. You're asking it to meet EV demand, which we didn't talk about because it doesn't use gas, but that's going to be quite significant. The hydrogen component is massive, so in a massive increment in power demand. And then, of course, replacing rescom, replacing industry, replacing a few other bits. And what that means is it only allows you to have this very, very small demand in gas use, because you are asking it to do so very, very much. Now, with my last point is you can kind of put all that together and you see all of that makes sense. But there is one big piece of policy inconsistency. Can anyone tell me what's inconsistent about this end story? And the answer is, going back to the first slide we did, is the ETS cap is already 0. And with an ETS cap of 0, that means all of that gas demand would face a potentially infinite CO2 charge, because there's no cap left. There's nothing allowed left. And of course it won't be infinite, because something will break. And what will break? Well, what will break is it will mean we will need less activity, right? So the assumptions we have is we have too much stuff going on, too much demand, and we have to get that demand down. And the only way to get that demand down is to reduce the amount of activity that we actually do. So in other words, it does open up Europe to big issues around deindustrialization and the reduction, probably, in living standards. On that cheery note, I'll kind of leave it there and pass it over to Richard.
Thank you very much, Trevor. Thank you. A couple of questions from me, Trevor. There's talk in Germany potentially about building gas plants, gas-fired plants, as backup or whatever, maybe as part of a capacity mechanism or not. Do you see that happening?
I mean, I think it's really difficult for any utility to come out and say, I'm going to build a gas-fired power plant now, particularly in Western Europe, but anywhere in the EU. And certainly there is that policy inconsistency of who is going to buy, who's going to build, you know, a combined cycle gas turbine, when actually by 2040 you might not be able to use it at all, right? Because the policy that we baked in is saying we are going to be fully decarbonized regardless. And we have something very, very strong in the EU ETS to say that you wouldn't be able to use that. So who's going to, you know, starting now, you know, in 2023, get your permitting done, take 3 or 4 years to build a combined cycle gas turbine, just to say, well, actually, it's going to be really hard by the time we get past 2035 to use that at all, because the existing gas plants would use up most of the, you know, whatever cap we have left as you start going down and down. So there's a huge amount of policy inconsistency in saying, well, actually, we're going to rely on thermals for a lot of the balancing that you would need to make power work, right?
But then that also begs the question of the 2030 coal exit in Germany. Do you think that's realistic?
There's realism. I mean, I think in terms of, you know, if you look at where the build goes, then you're probably going to have lots of renewables. So in terms of actual power generation, that's probably okay. You probably can get rid of, you know, coal, and, you know, but in our assumptions, certainly it has probably, you know, very, very little coal left beyond 2030. That's probably not the problem. The problem becomes juggling and moving that generation around to times when it's needed, right? And you come up with these big issues of storage, and I don't think Europe is doing anywhere enough on batteries. You know, if you look at some of the North American states which are very, very keen on renewables, and yes, there are a few of them, certainly California and Texas, very, very, very big renewables market, there's also a huge amount of investment in batteries, grid-level battery storage. And we don't get that in Europe, right? We put in 55 gigawatts of I think 40 gigawatts of solar last year, 15 gigawatts of wind, but we hardly put in any battery at all, right? So how are you going to manage the within-day swings without a heavy, heavy investment in battery? And at the moment, we just rely on the thermals to backfill all of that, you know, backfill that swing. But that swing will become bigger and bigger and more important. I mean, the other thing, of course, is you can add all of that technology, you know, you can add all of that generation, and, you know, we saw the big, big reliance on solar, you know, and the big issue is, well, solar generates really for 6 months of the year, right? And it's not when you have the highest demand, if all of a sudden you're going to put all of that heating demand from gas into, you know, which is winter-based, into the market. So how do you then, you know, get enough seasonal storage of power to move all of that generation from the summer and get it into the winter peaks, right? That becomes really, really complicated and very, very difficult indeed.
Just a final question, because we are a little bit short on time. Well, Julia, you've got a question. Yeah, it's up to you.
Thank you, Trevor. I was just wondering, I'm a bit shocked actually by this European gas demand forecast, or is it a model? I don't know. But so it looks like by 2050, the power sector will still be using like a lot of natural gas. Is that for natural gas, or does that include H2 as well?
That would that is just the natural, for us, that's the natural gas component. We have a little bit of blue hydrogen, so that would, but that's that orange component which is coming, which isn't that big.
To decarbonize by then, right? So how is
well, exactly. That's in some ways that's the key kind of bit of this story. Is it's not really the industrial piece and the ResCom piece which is going to be really problematic to do. It's going to be the power bits, which is really problematic to do. And that's because we're taking all of the demands from a whole bunch of sectors, from the industrial sector, the residential sector, the transportation sector, and we're sticking it into power. And so, yes, we do have the solutions for largely generating capacity with no CO2. But even if you throw an enormous amount of renewables at it, because you're adding so much demand and you're also taking out a lot of baseload capacity, i.e. you're losing all of your coal-fired generation, you're doing all of these things, you just have this big generation gap that becomes very, very difficult to fill without keeping gas on for longer.
Trevor, I think I'm going to have to stop you there. But I was going to ask you something about CCS, but maybe we'll save that for another time. Thank you very much, Trevor Sikorsky.
Thank you.
Here's Trevor. Trevor, don't run away. Here's a little present here. So from gas, the cheery note that Trevor ended on in his presentation, we're going to move to the industrial sector and look at ways in which industry in Europe is meeting its climate targets. And to talk us through that, apologies if I get your name wrong here, but it's Ping Sheng from IKEA, who'll talk us through what IKEA is doing to meet its targets. Please, the floor is all yours.
So thank you, Richard. Yeah, so hi everyone. My name is Ping Zhen and currently working as a sustainability energy specialist for IKEA. I'm currently based in Dortmund. So today I'm pleased to be here to represent IKEA to talk about the program of renewable electricity for our IKEA supply partners. And I'm personally leading for 3 markets, Germany, Sweden, and Lithuania. So we will talk about what our program is doing later on. And as we all know that under the climate emergency, it is more important than ever from the business side to act to limit the global warming to 1.5 degrees. And IKEA, as a multinational company, we have signed up to science-based emission reduction targets. And also we are committed to the UN Global Compact 1.5 degree pledge, which comply with the most ambitious temperature reduction goal from the Paris Agreement. And we also firmly believe that it is important from the industrial side to urgently reduce their climate footprint. And to be aligned with the 1.5 degree goal, IKEA is committed to become climate positive by 2030. And how do we mean by being climate positive? Is that we aim to reduce more GHG emissions than than our value chain emits while growing the IKEA business. And how is it possible to do that? We see there are 2 important factors. First of all, is to drastically reduce the GHG emissions. Later on, I will cover more in detail with our program how we are achieving that. And second of all, is to remove and store carbon from the atmosphere through forestry, agriculture, and products within our IKEA value chain. And however, it is important to recognize that we see the carbon removals and also storage could never replace the option of drastically reducing the GHG emissions, because we believe that it is important to address the root cause of our climate footprint within our value chain. And the carbon removal and storage can only neutralize the remaining emissions after they have been reduced as far as possible. So to achieve the climate positive goal, that we wish to achieve this goal without only using the carbon offsets, but to really cut down our emissions within our IKEA value chain. And in order to drastically reduce our emissions, IKEA is moving towards 100% energy and also phasing out fossil fuel across our value chain. So it means not only the IKEA own operations, but also including the supply partners' operations. And we have set the goal to reach 100% renewable electricity by 2025. And the remaining energy, including the heating and cooling, should also be renewable by 2030. And from the production perspective, that we also aim to reduce the absolute GHG emissions by 80% by 2030 compared to the baseline 2016. And towards our journey to 100% renewable energy, we are taking a full value chain approach. And what do we mean by that? That we are taking an extended responsibility to address the emissions that do not account for IKEA's climate footprint by our customers, suppliers, and in our sourcing areas. So these emissions, they are not even belonging to our Scope 3 emissions, but anyways, we help to support our supply partners to address these emissions. Actually, they are using for the operations for other customers. And for this part of emission, we do not report it into our sustainability report, but with this extended additional reductions, we call it Beyond IKEA. And in the IKEA Sustainability Report FY22 that we have released in February this year, that we have shown that we managed to decrease actually climate footprint by 5% compared to FY21 and 12% compared to FY16. So this is mainly actually driven by the efforts that we are moving towards 100% renewables. And the result also shows us that we are driving our business into the right direction. And since IKEA's climate footprint, actually almost 2/3 of the climate footprint is directly related to our supply chain. And that also includes the production from our supply partner side. So that's why back in 2021, we have launched a program called Renewable Electricity Program for IKEA supply partners. That at that time, we want to support our IKEA suppliers to accelerate their efforts into transit into 100% renewables. And firstly, we have selected 3 markets, Poland, China, and India. And these 3 markets were selected because they account for over 50% of the emissions generated from electricity consumption from their production sites. And also that we see some of the markets, it's quite challenging for our supply partners to secure the 100% renewable electricity by themselves. And if we achieve 100% renewable electricity for these top 3 emissions countries from our production value chain, actually we can save the CO2 up to equal to IKEA yearly ocean shipping. So that's quite a positive number. And afterwards, we see quite good progress achieved from these 3 countries. We see so-called wave 1, that you can see a green color in this map. So we decided to expand the program to 10 additional markets. We called it as Wave 2 since this year, actually. And these 10 countries, most of them are located in Europe, plus Vietnam and Turkey outside Europe. And as you can see, Germany is located as number 4 from these 10 countries in terms of the climate footprint. And if we add up Wave 1 and Wave 2, these 13 countries together, we can achieve almost already 70% of the emissions to be covered. And right now, I'm going to talk about the renewable electricity staircase. That is a staircase we see through our program. How can we support our supply partners to secure 100% renewable electricity? So the higher steps it go, it means the higher priority we see as solutions to support our IKEA supply partners. So I will start with the highest staircase. It will be the on-site solution investments. So that it means to invest solar panels on the premises, either on the roof, carports, open ground, or combined heat and power plant, or on-site solar, and so on. And since 2019, that IKEA also has launched loans called 100 million euro loans to provide an financial option for our supply partners to do such investments, because we see such investments shouldn't be a barrier for our supply partners if they have a good business case to work on. But however, usually such on-site solutions, we see it's only possible to cover 15 to 20% of the total electricity consumption needs. So the rest should be purchased from the grid. And moving down to the middle step, that will be the off-site solution that either direct ownership or PPA. So the PPA that I believe most of you here are really familiar with, that would be the long-term electricity agreement between the buyers and sellers. And we see this option beneficial for both sides. So from the seller side, it will be possible to secure the long-term cash flow. And from the buyer side, it could help hedge the spot market risk, but at the same time, it could be able to estimate their long-term electricity costs. And both the highest step and the middle step, that we see they are adding additionality to the markets because they are directly building new renewable energy assets on the market, so to say, to drive additionality. But however, in some markets, we see from our suppliers that the PPA market is not mature enough or not feasible, so that we will go to the lowest step, that will be the energy attribute certificate, so to purchase the EAC. That will be the easiest option actually for our suppliers to do the renewable electricity transition, but at the same time, they will be able to make such credible claims that they are consuming green electricity. And this graph shows that in each market, how we are actually running the program to really support our supply partners to secure the offers that we give to them. So in each market, we have done the pre-study that we researched the available renewable electricity products and to analyze the costs and benefits and the relative risk, since every market is really different with the renewable electricity profile and so on, and also with the regulations. And afterwards, we also done the external stakeholder mapping, so to identify the potential sellers in terms of geo and also PPA providers who could potentially be interested joining our request for information process, the RFI. And if they are interested, then they can submit the bids to our supply partners to say. And at the end, we have presented these collected geo and PPA offers to our supply partners. And if they are interested in any of the offers based on their own business plans, then they can reach out to the sellers to continue the following discussion and also contract final close-up. So overall, in the process, for most of the countries today, we have already closed up the RFI process and also presented the offers. And we are excited to see what will be the final outcomes that we can achieve to support our suppliers. And finally, that by working together with our suppliers, at least from the Wave 1 countries, we have seen that it's possible to support the suppliers for them to purchase and access renewable electricity in a better way. And also, since IKEA usually has a long-term close relationship with most of the suppliers, so in most of the cases, IKEA has a large turnover of a business, or usually sometimes it's 100%. So in this way, our suppliers are very much into our business value chain, but at the same time, we share the same values and also the same vision, that we have a quite common strategic fit together. And in this way, it also further helps build trust and also information sharing that we are towards the journey to work through the renewable transition together on our supply chain side. So I hope today's presentation from my side could kind of serve maybe an inspiration also for other industrial customers to support their suppliers to cut down emissions. And just to close up the presentation with the quote from our IKEA founder, that we are just at the beginning of this renewable transition journey. And however, we are positive about the future and also what the things we are doing now. And we do hope that we can create the transformation of sustainable business together. So thank you.
Thank you very much. Thank you very much, Pinchen. That was a fascinating insight into your business practice here in terms of meeting the climate targets. If I can just ask you one question, what's your evaluation of, for example, if IKEA is looking to sign PPAs or looking to have these kind of agreements, what's your evaluation of the PPA market at the moment in Europe in particular?
Yeah, so at least from our side, that we support our supply partners only with the physical PPA option, not the financial one. So the main reason is that because currently in many European countries, there are the initiative from the revenue cap and so on. So all these regulation changes add complexity on the market. And also most of our supply partners, they are producers, like manufacturers for our products. So they are not experts in the energy sector. So we think that it will be really complicated for them, and also too risky for them to be locked in such a CFD product. So that the main goal from our program is to only provide such physical PPA offer to our supply partners.
Excellent.
That's our standpoint.
Excellent. Will, are there any questions from the floor for Ping-Cheng? In that case, in the interest of time, we'll move on. So here's a little present from us, Ping-Cheng. So thank you very much again.
Thank you.
Thank you. Thank you. Moving from IKEA to another manufacturing industry, or manufacturing industry indeed, we're going to address the topic of leakage. We talked a little about this morning about potential deindustrialization issue and relocation to other parts of the world where the subsidies are better, or where may potentially that the climate regime is less tight, maybe. But to talk us through that and what the energy intensive is what the energy intensive industry is their leakage to low price regions is Chris Dye. He will talk us through what NSG Pilkington is doing here, what your view is. So Chris, please.
Hello everyone. Good afternoon. Thank you very much to the Montel team for inviting me to speak to you today. My name's Chris Dye. I'm based in the UK, and I'm here to represent Pilkington Glass. As I'll introduce, we are a glass manufacturer, glass that is sold into three major sectors, mainly the flat glass production for windows that you see in this hotel, windows that you have at home, but also glass for solar modules, as well as for vehicles and a few other interesting items like cosmetics and paints as well. I represent the energy procurement team. I manage that European team, and that's a group of 6 people who manage around 6 terawatt hours a year of natural gas consumption and around 1 terawatt hour a year of electricity as well. I also have a global role looking after renewable energy projects, so trying to transfer us away from that fossil fuel towards some renewable projects. Pilkington is part of the NSG Group, and NSG Group is headquartered in Tokyo, in Japan, but we still trade as Pilkington in most of Europe with a brand that hopefully most of you will recognise. Those 3 business sectors are listed there with some of the products that we manufacture. But yeah, we just make glass. A little bit different to some of our container glass contemporaries within the sector, but it's an energy intensive process and something that is obviously under a great deal of stress at the moment with energy prices, particularly in Europe. For those of you that have never been to a float furnace or seen a video, I'd encourage you to go onto YouTube. Pilkington has got some great videos giving an insight into the process. In essence, we turn raw materials like sand into glass, and that is done through a very high temperature process. Our furnaces operate around 1500 degrees Celsius, and they run continuously for 15 years, sometimes even longer than that. So our investment cycles and our thinking is shaped very much by that we make a commitment, a large capital intensive commitment, and we run with that process for 15 years. And that has shaped some of the reaction that we've had during the last 2 years, particularly in Europe, to where pricing has been. We produce up to 800 tons of glass per day on each of the lines, and we've got 28 of those furnaces operating globally. A little snapshot showing our footprint, a very strong presence in Europe, North America, South America, Japan, and also in Southeast Asia as well. We also onward process that glass, so the energy costs are not just borne by us. We also sell that glass to customers who will shape that glass, they'll toughen it, that they will bend that glass and sell on to other businesses as well. So a key part of the topic that I've been asked to talk about today on price leakage, it's not just related to us. A lot of our customers are energy intensive as well, particularly those within the solar sector, where they again heat that glass up to high degrees. We're part of the broader economic environment and selling products into the automotive, the construction sectors, that there are obviously wider effects from the energy price crisis beyond our direct additional cost. Within Germany, we manufacture glass at 4 furnaces. 2 of those are in the Weierhammer site in the south of Germany and 2 in Gladbeck, not too far from here. And then you see those other sites which are all part of that onward processing of the glass that we manufacture. So yeah, this is large scale production. Each of those furnaces uses about 5,000 cubic meters of natural gas every hour. And so on an annual basis, each furnace uses about the same amount of natural gas as a small town, 25,000 homes or so. So that's why we're seen as a real centre for the kind of future decarbonisation. It's much easier to decarbonise us than it is 25,000 homes, as I'm sure you can imagine. A few pictures of the sites, just to give a size of the scale of what we do, and just to say that these are not easy processes and sites to just pick up and move. That these have been in place for decades, and actually transitioning those now to alternative fuels is the big challenge that we have. Some of the products that we make, some familiar buildings, and there are many others as well. The picture in the bottom right, that was glass made in Germany and actually went across to the US for Apple's headquarters about 5 years ago. So our products are mainly sold in country, and that helps us to locate our processes as close as possible to those customers to minimize transport costs. Glass is obviously heavy, it's fragile, but there is actually quite a large risk of leakage from other regions, particularly in the automotive sector, where we do see quite low-cost production in other regions coming into Europe and being sold as a price that really undercuts the price that we have. And I'll come on to mention a few kind of pain points with regards to that in the next couple of slides. We have committed to a science-based target. We are working towards a carbon neutrality target of 2050 with some interim steps, a 30% reduction in our scope 1, 2 and 3 emissions by 2030. And as you can see from the split there, a large proportion of our emissions comes from the fuel that we use and the energy that we purchase. So a lot of that responsibility is falling on to me and my team to identify opportunities for us to reduce those emissions. So as I mentioned, glass manufacturing is an energy-intensive process. That process has been slowly evolved over the last 60 years since Pilkington introduced and designed the float process. The further developments to improve that efficiency are now very small. So we need big fundamental change. And actually, the key to that is touching on the energy price. And typically, energy used to make up about 20% of our input costs. Now, as you can imagine in Europe and increasingly globally, that 20% has increased as energy prices have risen. So that has put a huge stress on us as a manufacturer. We've been, I think, very well supported by a number of our customers who've been actually quite responsive and quite flexible to support us and actually to agree to
adjusting prices to changing commercial terms for the sales contracts that we have. And I think without that flexibility, that would have been really difficult. Me and my team work very hard to manage the risk as best we can. We have quite long-standing hedging policies in place, particularly for natural gas, that they typically go out for a 36-month period. So we're quite active in the market to forward buy and take advantage of opportunities. And some of the gas that we're consuming today was bought 3 years ago. So that looks obviously like a really great purchase and a great decision. But in the same way, we're purchasing gas today that will be consumed in 36 months. So I think that policy helps us to avoid some of the real spikes and the potentially miss out on some of the real dips in the market, but it gives us certainty. And that horizon of a 15-year campaign for a furnace, as you can imagine, that there's a real need for certainty when you're making that commitment. To build a float line, you're looking at probably 300 million euros, and that commitment has to be made with a good idea of what those input costs are going to be, particularly when energy is quite as front page news as it has been. Pleasingly, the collaboration between my team and the rest of our business units has been really strong. Sometimes you've got to be careful what you wish for, and a bit of an elevated platform as energy procurement within the business, has come with some challenges. But I think we've navigated most of those quite well so far. One of the key things for us is obviously carbon cost. So within Europe, we are uniquely faced with a carbon cost compared to our sister plants elsewhere in the world, which don't have that carbon cost. That is an addition that we have to build into the cost stack for glass that's manufactured within Europe. So, managing that EU ETS allowances and that scheme is actually a job in itself, and we have someone who manages that very carefully. We're quite interested to see how the CBAM initiative plays out for glass as a sector, and that will be key, I think, to a lot of the work that we do in the future and to our competitiveness, because, like I say, we are starting to see a lot more glass now flowing, despite its kind of fragile and heavy nature, into Europe from other regions. We are trying to focus our attention a little bit now on how we can differentiate ourselves beyond price. And I think this is really where we've, as a business, made really positive progress in the last 12 or 18 months particularly. We're moving towards value-added products rather than commodity products, and actually supporting customers with their own decarbonisation targets and efforts as well. This slide just highlights some of that work that we've done. In the last 18 months, Pilkington has actually achieved 2 world firsts. We fired a furnace using hydrogen, and we fired a furnace using a biofuel. So a lot of talk about hydrogen today and obviously within the market, but these are real world first scalable trials that we've undertaken and actually prove that we can manufacture the product but without any cause for concern on quality and on stability within the furnace. And again, I'll mention the long-term nature that we have. We are very risk averse technically as a business. So to do this, to achieve these trials, I think has been a real success internally. And I think in terms of trying to insulate ourselves from energy price rises, these fuels are more expensive than natural gas today. Of course they are. But we're putting ourselves in a position where we have a greater number of options available to us. And ultimately, we're supporting our customer, who will be the one that decides whether we live or die as a business, by allowing them to achieve their targets. And ultimately, I think that's why we're here and where we're trying to get to as a business. Okay, thank you very much. Appreciate your time. Quite happy to take any questions, Richard, or any from the floor.
Excellent, Chris. Thank you very much. I think it's particularly interesting to the example there of an industry such as yours are using hydrogen, as a pilot pilot case. I think that's very interesting to see. Question about last year, as prices for natural gas and for electricity soared. Were you forced to curtail production at all?
No, we weren't. We did a bit of fuel switching, actually mainly in the UK, but we kept production going. One of the unique factors of glass manufacturing is you can't stop the furnace. If you stop it, everything implodes. You've got to build the furnace again, and that's 50, 60 million euros. So our hand was forced. What did happen actually is that we put in a lot of alternative firing systems. So we put in temporary storage facilities for liquid fuels, for example. So the focus, I think, shifted away from decarbonisation at that point towards stability, towards maintaining production.
Survival.
Yeah, exactly, yeah. But we were able to do that at a cost, and that cost ultimately has to be passed on to the customer. But yeah, we were able to do that successfully, and I think it's put us in a better place for the next 12 months as well.
Absolutely. And there's been talk, today, this morning, about deindustrialization. Do you think that threat is real?
Yeah, I do. I mean, look, I think we're part of the wider economy, obviously, and our products themselves, some of them are luxury items, some cars and nice vehicles, things like that. But that there is a competition in terms of energy prices that feeds into all types of manufacturing, and ultimately, if Europe cannot be competitive on an energy basis, then it cannot be competitive as an industrial base. So we need that support to be there, to be maintained, but also to grow as well. And the way that we're doing that, or trying to do that, is to, in some ways, move away from some of the more traditional fossil fuel markets with hydrogen, with biofuel, to broaden our range of options that would allow us to dip into other fuels and be a little bit more flexible than perhaps we have been in the past. But yeah, the risk is real. Yeah,
absolutely. Any questions from the floor for Chris? Yeah. I was just going to ask you as well about, following on from that, the carbon border tax, or the CBAM as it's also known, would that go some way to alleviating these kind of these issues? Is that something you'd welcome?
Well, I think in principle, yes, we do welcome that, because Europe is on an uneven footing at the minute. That there are talks of similar mechanisms elsewhere in the world. I think we see something coming in Japan and also in some parts of South America. But at the minute, Europe is paying a premium for the right reasons, obviously, but is paying a premium to produce glass. So, I think we welcome the principle. I think the detail, there's a lot of work to do there to get our team comfortable with what's proposed. But I think we need something to level the playing field as Europe PLC.
Excellent. Thanks very much again, Chris. Brilliant. Okay. And here's a little present from us. Thank you. In the final session before we take a break, we will look at, we'll return to the subject of PPAs. Now, we've talked about that quite a bit today, but to talk us through the current state of play in corporate PPAs is Tekla von Bülow of Aurora Energy Research. So, Tekla, looking forward to hearing another perspective. So, the floor is all yours.
Perspective?
Yeah.
Perfect, yes. So I'm very well aware I'm between you and the next coffee break, so I hope to make this short and crisp. So yes, we will talk about the role of PPAs, very specifically for the German case, and look around what is actually the role of decarbonization or the role of PPAs for the decarbonization of the market, how much of the industrial decarbonization will actually happen over PPAs, and how do we expect the German market to be developing towards 2030 in terms of how much demand do we see for PPAs for the different sectors, but also how much supply will there actually be. And in addition, we will be looking into what are actually the big uncertainties around both sides of the market, so demand and supply for PPAs, given some possible regulatory changes and market changes, so specifically acceleration of the renewable build-out. As a quick introduction, I'm aware that you have discussed PPAs this morning quite a bit, but just to give a general impression of the current status of the market, the PPA market is picking up again. In Germany, there's quite interesting PPAs that have been closed recently, which I find really interesting for several reasons. So the RWE PPA that was closed for Amrum West in Germany is, in my perspective, quite an interesting structure because there were multiple off-takers at the same time coming together in one PPA. This is a discussion that we're having in a lot of markets. How can we improve access to the industry to PPAs, especially for the ones that are less credit-worthy, that have less large volumes of demand? How can access to PPAs be improved? And we do see pooling structures of different industrials coming up in different countries. The other one, also for an offshore wind park, was announced a couple of weeks ago, actually at one of our conferences in Oxford, which was great, from Iberdrola and Amazon for an offshore wind park in the Baltics, which is an offshore wind park that had higher subsidies, was falling on a lower level, and PPAs here have enabled to continue running the offshore wind park at a higher price. So what we can see is that PPAs can be an interesting alternative to subsidies, especially in the current market stage. And we do see really activity picking up again now that the price is a bit more stable. We see a lot of transactions that had been put on hold where the price negotiations was really tough, that now the market is becoming easier again. So this is really great news and good to see. The 2 points that I would like to discuss or show you today is, on the one hand, what is our central view on how the supply and the demand of PPAs will match up by 2030, and we will then be discussing how some of the main uncertainties might be influencing the balance of PPAs in both supply and demand. So in our central scenario, what we see is that there's actually quite a large imbalance between the total PPA demand that we see in Germany until 2030 and the supply that we see, so supply from renewable assets. There is actually 54 terawatt-hours of imbalance, which is basically due to not enough renewables actually being accessible for PPAs currently. There's always a big alternative option to go for subsidized assets, and only parts of the capacity of the renewable build-out is actually available for PPAs. In terms of demand, we usually break down the demand into different sectors. I'll go into more details, especially on the corporate demand, but we differentiate between the corporate demand, the utility demand, and the electrolyzer demand. The utility demand in Germany, in comparison to other countries, is actually fairly large. It is a big market to close, as a developer, to close a PPA with a utility. There's lots of smaller utilities, Stadtwerke, municipal utilities, that are looking for green power to then hand over to a kind of more local industry, also to end consumers. So this bucket of utility PPAs is fairly large. but also Germany has a lot of industry, and so corporate PPAs are a growing industry also for Germany, where a lot of corporates are actually thinking about closing direct PPAs with developers, which we will go to in detail on the next slide. The electrolyzer demand is also here for the central case at 15 terawatt hours. As we know, we have spoken a lot about green hydrogen as well. Germany is banking very much on green hydrogen, and for these projects you will actually need to close high quality PPAs in order to actually be able to call the green hydrogen that you're producing actually green. On the supply side here, we have also different buckets, which basically consist on the one hand on new build assets, so closing mostly long-term PPAs with either solar assets, mostly in Germany, some offshore wind, a little bit of onshore wind, because most of onshore is going into the auctions. We have a couple of lifetime extensions, as we call it. So, for instance, the offshore wind PPAs that I showed on the previous slides can be called lifetime extension in that way, but mostly we talk about post-EEG PPAs, so PPAs that can be closed with assets that have reached kind of the end of their subsidy scheme after 20 years. For these assets, you can close PPAs for a couple of years. That can be quite attractive for the industry, actually, as a kind of first step into the market if you don't want to commit for a 10-year PPA. In terms of kind of the there we go. I pressed a lot now. There we go. In terms of the breakdown between the different industries, looking at the corporate PPA demand in more detail, there's first of all here on the right-hand side the total demand of industry that we will see until 2030, and the little orange bucket here is what actually we see as PPA demand until 2030, which was flowing into the previous supply-demand chart. And this might seem quite small compared to the actual total demand. There's two aspects that I would like to mention here. On the one hand, in our central scenario, we don't expect most of the industry to be decarbonized in time. Here we are at 2030, so still far away from 2050. So we don't expect a majority of the industry, especially the energy-intense industry, to be decarbonized by 2030. The other aspect that I need to mention here is that we have a funnel in our demand projections, which is around creditworthiness of the industry. So in our analysis, we assume that most of the uncreditworthy industry is not able to close PPAs, and hence here is falling out of the potential demand for PPAs what's the word? Not voluntary, but because the market simply doesn't allow access to this industry. In terms of kind of who is active in the market, we differentiate it in four categories. We call it the green giants, the green image seekers, the price hedgers, and the intermediates. And what lies behind this categorization is two dimensions. On the one hand, how energy intense is a company, and on the other hand, how big is the pressure for an industry to decarbonize on the one hand, due to the capital markets, their own employees, their value chain, their clients, and the green giants are the ones that have high stakeholder pressure to decarbonize at the same time, quite energy intense. So for instance, the technology companies would fall into this category, which are very active in the European PPA markets. With the green image seekers here, it's the high stakeholder pressure, less energy intense, so consumer good companies where the marketing effect of decarbonization also plays a big role. So they're the ones that ideally would like to put put their logos on the turbine to make it very visible that they are being very active in this field. The price hedgers are a really interesting group. So these are the ones that maybe not have kind of this visible stakeholder pressure from, for instance, their clients. So the contrast to the great image seekers. But they're the ones that are very price sensitive. And we have seen, especially in the last year, a lot of interest coming in from price hedgers, so very energy intense companies, looking for PPAs to actually hedge their power procurement long term. These are companies that use PPAs as one of their pillars of their hedging strategies, actually looking for longer term PPAs to really secure prices. And what we can see is that PPAs, closing a PPA can actually be a really good deal when you think about the renewable capture prices becoming substantially lower than the baseload prices that we are seeing. So really interesting group, really rising interest from this group. Intermediates are just the rest of the group. In terms of what are the main uncertainties that we are seeing in the market, and this is not an exhaustive list, right? So there will be more uncertainties there, but there's 3 specific ones that I would like to discuss. Which are quite relevant for Germany. On the one hand, the RED III, what do we mean by it? It is the possible fact that GOs might be issued for subsidized assets, which is something that Germany, quite as an exception to all European markets, doesn't have. And so we will see that this has an effect on the PPA demand, less so on the PPA supply in our projection. The second one is giving you an impression of what would it actually mean to accelerate, take a more ambitious scenario than our central scenario, so or as the second main scenario as being the net zero scenario, which is saying what would it take to actually get to net zero until 2050. And here we will see a bit of a surprising impact both on the PPA demand and the PPA supply side. And the third one, quite a relevant topic, is around the EU proposal around the EU market design and what impact do we see here on the PPA market. Here again, both on the supply and demand side. The issuance of GOs is something that is currently in this proposal of RED III, but there's a lot of uncertainty of whether this will actually come. So both the Parliament and the Council have already said that they are not especially in favor of it, so we don't know whether it will actually come or not. The effect will be in our projections that the imbalance will actually be decreased in between supply and demand for the reason that the total demand will go down. What is the reason for that? We believe that if there's a lot of guarantees of origin coming to the market, that a lot of companies might go for these guarantees of origin first before trying to look for a PPA, which for the moment is quite difficult to get. So this would, all in all, kind of reduce a little bit the pressure. On the other hand, probably a bit less activity on the PPA market to be expected. In the second uncertainty scenario, here is on the net zero path. So this is the scenario where renewables are more ambitious and also where the industry is looking to decarbonize. Here actually the effect might be a bit surprising for a couple of you. We actually see a decrease both in PPA demand and in the PPA supply. The reason on the demand side being that we believe that there will be a good level of greening of the power system anyhow in this scenario, so that again the industry would not necessarily require PPAs in order to decarbonize, but would rather go for greening through the grid itself. Whereas on the supply side, also an interesting effect, we see additional complexity in actually closing PPAs. The reason is that the LCOEs, so the levelized cost of electricity, are at a much earlier stage higher than the renewable capture rates that we see. So the capture rate being kind of the generation-weighted prices for renewables, and the more renewables we see in the system, the more this cannibalization effect increases. And in our net zero scenario, the capture prices crumble so much that they fall below LCOE. And then the question is, would you still close a PPA under that kind of condition, which are mostly based on or priced on market prices? And given that circumstance, would you rather go into a CFD rather than for a PPA? And this is the main reason here where we see the PPA supply going down. In terms of the third topic here, the proposal of the EU Commission, the EU Commission has made a series of proposals on the market design. Generally, it is less or much less fundamental than some of us might have expected before the proposal was issued. But what is very clear out of the proposal is that there's a very strong commitment for PPAs to become a pillar of the European decarbonization. And there's 3 areas which are a clear indicator for how the PPA market could further be spurred. On the one hand, so here risk exposure, there is a sort of obligation for the different national governments to build up guarantee funds or guarantee instruments to cover for the default risk of the industry, and with that enable market access to, as I mentioned, this on-credit-worthy part of the industry. This could really help corporates to further gain access to the market. It's also something that we already see in some of the other markets, such as the Nordics. Spain has already implemented such an instrument. I think the Netherlands are working on it. In Germany, I think the KfW is working on an instrument. It's not there yet, but it will certainly help also in the German market for the German Mittelstand. In terms of support scheme, there's a lot of discussions around CFDs and how they might be able to be combined with PPAs. Here, it is in Germany quite a big impact because we don't have two-sided CFDs in Germany, and the big question is how will it be translated into national law once it comes, and how will it actually be designed. Depending how it will be designed, it might actually have a positive or a negative impact on PPA supply. If there's a possibility, for instance, like in the Polish scheme, to combine the PPAs with the subsidy scheme, that could be, for instance, a really interesting mechanism. On the other hand, there's further incentives to further provide market access to small and medium companies or part of the industry, to make that part of kind of tender criterion. This again would help both spur the corporate demand side and also the supply side. And last but not least, there's a commitment to actually help utilities further spur their hedging activities here for various reasons. On the one hand, ensure that the markets remain liquid. Kind of the derivative markets really lost a lot of liquidity in the last year, which was an issue not only for the PPA market, but also for utilities to secure prices. So these further hedging obligations could, on the one hand, help demand for utilities that would need to close PPAs as part of their strategies, but also help developers close PPAs and further enable the market here with the utilities. So these are kind of the main uncertainties that we see around the PPA imbalance market between demand and supply. As I said, it's not an exhaustive list. There's obviously more uncertainties in the market, but I think these are three that are quite relevant right now. Thank you for your time.
Perfect, Tekla. Thank you very much indeed. An excellent overview of the uncertainties. There's still a lot of work to be done, and certainly on the proposals that come from the Commission. If I can ask, there's two areas which I'd like to pursue a bit here, Tekla, and the first is on, which you mentioned a couple of times, on the credit worthiness, so the credit issue. Currently, are banks changing the way they improve credit risks at all, given the situation we've seen over the last 18 months, say?
Yes, but not in a good way, I would say,
Okay.
unfortunately, right? Yeah, so inflation plays a big role in the perception of banks and how they assess it. I mean, they were always looking for a stable business case. So fixed price as much as you can, long tenors, if it's for a new build asset, no volume risk if possible. In Germany, that's a big issue, so base load banks really don't like. But credit risk was always a big part of the assessment. And given we are in an economic crisis, credit worthiness is becoming more of an issue, as well as the inflation risk on PPA prices. So it's definitely not made the willingness or the openness of banks better. In general, it's also a matter of there's only actually very few banks that are active in the PPA market, and so there's only very few players that the market participants can actually talk to, and this also is an issue in actually getting a market ramped up. Yeah.
And so if I understand you correctly, they're more reluctant now to finance baseload PPAs, or?
In Germany, for sure, yeah,
Yeah,
no, they wouldn't do it anyhow, really. No, in Germany, baseload is much more, a much bigger issue than in the Nordics. We don't have any hydropower, or not a lot, and so the only base load that you could do in Germany is by having base load from another asset outside of Germany. So no, if you're really building a new asset, they would be looking for an as-produced profile. Yeah.
Perfect. And another key issue is attracting smaller firms into this market, because it is dominated by the big players. But could we see potentially a rise in sleeved PPAs if more smaller off-takers come to the market? So, for example, the ones not able to buy large amount of capacities, so then they have a third party sit in the middle. Is that an option for, or increasingly an option for smaller players looking to enter PPA markets?
I think for smaller players, you'll have to sleeve a sort of anyhow, right? To make it integrated into their power demand, they need a sleeving entity anyhow, and whether that's the same player or a different one, that can be decided from transaction to transaction. But what I really find interesting is those pooling structures, as I was saying, where different parties come together and take part of the generation, and then sort of spread the default risk over that bigger group. So these kind of structures we have seen in the Netherlands, and also in the Nordics. So it's interesting to see that also German players are thinking about it. Yeah.
Excellent. Any questions from the floor? Yes, there's one here for a couple. One from Frederick Bodecker.
Yeah, hi. You mentioned the RED III, but if we look at the RED II and this delegated act now that kind of stipulates that to have green hydrogen and green methanol and green whatever, you need temporal correlation from 2030. and we see a lot of let's say, client in that space that are really scratching their head. How are we going to solve that? Do you have any thoughts on how that will affect the PPAs?
So more granular GOs, you mean? Yeah. Yeah.
Yeah, and that if you sign a PPA with a wind park with 3,500 hours, then you can only run your electrolyzer exactly that hour when the wind park is.
Yeah, indeed. So it's again not making lives easier for electrolyzer projects in Germany, where you basically, instead of being a hydrogen producer, you become a power trader because you need to oversize your power procurement, ideally with an offshore wind load in addition to a solar load. Then you will slowly get to the hours that you need in order to be able to procure the electrolyzer. But in addition, obviously, it's very difficult to close PPAs with the very high criterion that was set. You mentioned temporal correlation, but also the matter of additionality is a massive issue. If you're looking for PPAs from an offshore wind park, there's basically two in Germany. There are 0 bids, which is Borkenhofen 3 and He Dreiht. The others are these post-subsidy offshore wind farms. Luckily, they extended the period a little bit until when you need the temporal correlation, which starts 2028, if I have it in mind correctly. So you have sort of the possibility to have a bit of a first mover advantage and try to close those PPAs with a more relaxed criterion now. But the other issue is around how do we actually do the reporting, because currently there's no way to do granular GOs for the moment. From the official AIB, you don't have a temporal stamp. And so there's more private initiatives around energy tag, granular startups that are providing the granular stamp for the industry which will need it. There's a lot of question of whether there will actually be granular GOs for the entirety of the industry or whether it will stay kind of a niche part for the hydrogen industry and find a solution just for that part of the market. But indeed, if you talk to the Umweltamt in Germany, there's little activity around how to actually implement it for the moment. Yeah.
Excellent. Was there another question here? Yeah, a final question before we...
Yeah, I just was wondering, because Frederick spoke about it before, for the long-term kind of hedging of your interests, what is your take to go to the exchange instead of going for the PPAs?
I didn't catch it.
Going for the exchanges, the products which are offered in EEX and ICE, which are long-term.
Yeah.
What is your take in, is this a positive subsidy?
Yeah, so there's probably people in the room that know much more about this topic, I have to admit. But yes, so for instance, EEX is offering different products with different durations. Actually, there has been a product issued for a 10-year duration, I think around 1.5 years ago. In order to actually be able to do these very long-term hedges, it had quite a good start, actually. But then with the crisis last year, actually, they stopped the product because it was simply not being traded. But with the incentives of the EU Commission, the proposal, it could be a very good way of ramping up these products again in order to increase the liquidity. So I don't think PPAs is going to be the only answer in improving the hedging strategies of the utilities, but it will also be the derivative markets that will be further spurred in order to improve the liquidity there. Yeah.
Excellent, Tekla. We're sort of running out of time now. I don't want to keep you from the coffee break here. So thank you very much, Tekla. Thank you once again. And here's a little present from us.
Oh, thank you so much.
We will now have a break for just over 20 minutes, and we'll meet back here at 3:35. Thank you. Move into the nitty-gritty of short-term markets. This is where the volatility, where the intermittency really comes into play. And we're also going to round off the day by talking about batteries, which have already been mentioned earlier in the day. Now, You may be interested to know that today, intraday price in the Netherlands are trading around minus 700. Is that right, Jean-Paul? Minus 700. So that's happening as we speak. But the first session of today, of this last session, about short-term trading, short-term power, and as a case study, and to talk us through that is Jean-Paul Harriman of Montels and Apsis. Please, Jean-Paul, it's all yours.
My first Montel German Energy Day today. As you can see below the logo of an Apsis, we are now part of Montel Group since February, so quite happy to have joined this great group of colleagues. So what I'll be talking about, a little bit about intraday trading and how sensitivity and context can help you make sense of what's going on. Yeah, just a few small points. I'll keep it short, so we'll have a bit of more time for the other speakers as well. So Apsis is originally a UK company. We're based in Stockton-on-Tees in the northeast of the UK, and I work in the Dutch office, as you can probably tell from my accent, in the southwest of the Netherlands. So Richard already said Dutch market in turmoil. Yesterday the day-ahead market failed to clear in the first auction. There was a second auction, and in the end we got the day-ahead prices of minus 195 euros for 2 hours, which second auction, so you would assume the problem would be solved. Far from it. Today we saw negative prices on the intraday market going as low as minus 700 with full activation of the complete stack of reserves. So 1,000 megawatts of downward reserves being activated. Even people not taking enough of our power, even if we were selling it at minus 700. So that will also impact the German market. So, I mean, it will not be news to you, but Germany is not an island. So we are in a European market. So what do we do as an Apsis? We do market data, forecasting services. I'll walk you quickly through this slide because you're probably not that interested in marketing, but we have public data. Basically you have one single source of truth, saving you a lot of money accessing data through API and platform. And then we have derived and proprietary data, that's where we add our value. So, intraday markets are super sensitive. It's basically, when I joined the energy market in 2001, the rock stars of trade floors were the long-term traders. So trading on the curve was where the money was made. And slowly but surely we've seen, especially with the coming of renewables, we've seen the focus of markets shifting to short-term. And yeah, part of that is of course weather-driven, so we're looking for sensitivities. If we're looking at day-ahead markets, we can actually tell a lot by looking at the auction curves. So if we do a simple what-if analysis, basically what you can do is shift the intersection of supply and demand curves, something we were taught in economics in school. If we just shift the intersection, you can tell, okay, 100 megawatts this way, 100 megawatts that way, what happens with the price? And basically that's visualized here. And you can see some periods with lots of color around, and those are sensitive periods. Those sensitive periods in the day-ahead market also reflect in the intraday market, because the economics of the underlying assets don't change. Simple as that. Gas prices, carbon prices are relatively the same as yesterday, so the marginal costs are very comparable. So if we look at this and then take it a bit broader, we can actually see that some periods have a very clear direction of the sensitivity. So you can see here, for example, there's more sensitivity downward than there is upward. And that helps you form an opinion about where could the intraday market go. Now, one very strong example was 11th of April, so just after Easter. The intraday traders in the market will remember that. So what we've done here is basically looked at the sensitivity in the day-ahead auction for different countries, because it's an interconnected market. So if there's an issue in one market, you can probably solve it by trading your way out of it with another market. As you can see, there's quite a bit of sensitivity on the upward side for all markets that we show here. So Germany and its western and southern neighbors. So massive sensitivity in upward direction for all of the most important borders. Now, this basically implies that on the intraday market, you can actually expect a tightness in the market. So additional capacity will be available, but at a premium. And that's also what materialized when we look at the market itself. So these are the balancing prices and balancing volumes of the different markets involved. So on the top, we can see Germany. I don't know what the price exactly was, but it was quite massive. So we saw extreme prices in Germany, France, Netherlands and Austria, and also in Czech Republic there. And these were the prices that were actually hit. So Germany, 7,000, Netherlands, I think almost 1,100, Austria, close to 6,000, and then France and Czech Republic, they have a different balancing regime, so they're not marginal priced, but the highest activation prices were also 5,000 and 6,000 euros. So this tightness materialized over different markets, and because the sensitivity was present in all those markets, they also reinforce each other, because the fact that there's a lot of sensitivity usually implies that there is not much cross-border capacity for trading in that direction as well. So that really interesting to follow that. And then the other markets, if you look at Poland, had a shortage in the same period, Denmark as well. So it's apparently something that happened across all of those markets. So sensitivities are key to understand when you're looking at intraday markets. And then, of course, we have renewables also feeding into the volatility. So most recent example was Netherlands. So we saw yesterday, the forecast for today was 16,000 megawatts of renewable generation in a market that has an average of 12 to 14,000 megawatts of demand. So you can see where the problem is. So the market didn't clear in the first round, it did in the second, but it didn't solve the problem because the fundamentals were still the same. Now, in Germany, the renewable penetration is also very high. It's not as high relatively as in the Netherlands. So in the Netherlands, total solar capacity is about 21 gigawatts, which is 1.5 times the average demand. So you can see that can cause some problems, and it's only spring, so we'll see where that goes. However, in Germany, we see similar behavior. So you can see the day-ahead price often hitting zero or going very low. And that means if you look at the fossil and flex chart next to it, that gas and coal and lignite will run at a minimum level. And that means they will only have upward capacity, a very little downward capacity, because it's not profitable to run above your minimum run level. And yeah, even then, it can be quite tight. And then during the evening peak, you can see a very sharp ramp up of conventional power. And in Germany, then that's also assisted by pumped storage, which is a big benefit of a country that's not as flat as the Netherlands. Yeah, I would love to see that kind of flexibility in my country, but unfortunately, anyone that's ever been to it knows that there's some hills at the beaches, but that's about as far as we go. We do have tunnels, though. So, yeah, we have a mountain stage in the Tour de France, or we had a mountain stage in the Tour de France, which actually meant that people had to go underground. So that was really good. So what you can see is that coal, gas, and hydro are basically used to compensate when the sun goes away and when the wind goes away. This is an old story where you also had like 3 gigawatts of baseload nuclear. Not going to go into that because I've had enough comments on that this week for my liking. But yeah, that's also an impact. So yeah, an example where this went a bit awkward was the 4th of April. As you can see, we don't have to go very far back in history to find crazy events. So we had one today, 11th April, 4th of April. Negative balancing price, it is provisional, but it comes from Netstransparent, so I assume they know what they're doing. Minus 4,500 euros with huge negative reserves. And the reason was there was a bit more solar than expected and a bit more wind. And all of the flexibility was already used. So as you can see, there was not, the blue here is gas, then the brown is coal and lignite. So there was quite narrow band of flexible generation. And you can also see here below zero, that's pump storage. So basically pumping the water back up the hill. 10 gigawatts of it, so that's quite a lot. So all of the flexibility had run out, and then the sun started to shine a bit harder, and then there's nothing left to ramp down anymore. And yeah, then the market goes into play. You get scarcity effects affecting the market. So yeah, that really helped the price to go as low as it went. But what you will also, yeah, it's hardly visible, but of course you also have to get out of that ditch. So we get a very low level of conventional power, but as the sun sets, and luckily in this case it was only the sun that lost its force, but as it sets, all of that conventional power and the pump storage has to ramp up again. And they're quite capable machines. They can do quite good ramps, but this was 20 gigawatts. Let that sink in. 20 gigawatts. I don't know exactly what the average demand in Germany is, but this is quite close to half of it on a sunny day. So 20 gigawatts of ramping, and it required speed because the sun goes down. It doesn't stop. You can't tell it to stay on for a bit longer. So you really need to know, what's the capability of the market? Can I still trade my way out of problems if there are problems? And what's the consequence? Where's the sensitivity? So for that you need to look ahead. And what people do is they create day-ahead forecasts or price forecasts, or they buy it from somewhere. I can recommend the company, but let's not get into that. So here is a dashboard showing what to expect for the coming hours. So the vertical line shows you where we are now, and shows you the past, and then the lightly colored areas are basically forecasts. And there you can see that this was a very boring day. Actually, the price forecast was very good that day, but it also shows you not a very steep ramp of fossil fuels and solar, but you can see here this blue line versus the green line. That's the day-ahead forecast versus the latest forecast. It was quite a big deviation. So there's also potential for volatility, although there will be enough flexibility online to deal with it because there's no steep ramps and people will have security to be able to run for the whole day. So that gives you an idea. Note also the green bands around the green line. Those give you confidence intervals. So confidence intervals are key to understand how certain we are about forecasts. So you can do a point forecast, and a lot of forecasting engines like neural networks and the like are very good at getting you the best possible forecast. But actually they're useless if you don't know how certain people are about those forecasts. So it's very important to know the certainty of the forecast to be able to determine what the value of the forecast is. So this gives you an idea of what could happen. So this is a very dull and boring day, but it does allow you to look ahead. And of course, you can look further ahead as well to see any potential problems in the market. So I think day number 5 is one where the black line, which is demand, passes through the renewables. So this is built up as a merit order, so the wind and the solar go first and then the conventional fuels. So that's a day where we have surplus. But also a very steep down ramp. And especially when the ramp down of solar or the ramp up of solar and wind coincide, that's where conventional power has a problem to keep up. Because it will not have a market, because it's being pushed out by those renewables during solar peak. So there will be very little, or very few assets online, and they will have to ramp up, or they will have to provide the ramping speeds to compensate when the sun goes down. So, yeah, sensitivities and looking ahead will be crucial for the coming months as the sun gains force, and we get to experience the true amount of additional renewables that's been installed during the energy crisis. And this is where you can see, so historically, conventional power being pushed out. This is the same day, but then going forward, similar event. And then here you see the steep ramps. Sorry. And then looking at other countries will help you to understand if there are options to get past that. So intraday trading is the best way to get yourself out of trouble. And we do sort of the same forecasts for other countries as we do for Germany, and we show you what the ramping speed required is for those markets. So here you can see France is expected to need a lot of speed for the evening peak, so there's no help going to come from France if there's an issue. It's much more likely to see help coming in from Belgium or even from Netherlands. And then, of course, the closer you get to real time, the closer you get to balancing markets. I can spend 3 days talking about balancing markets. I will not do that. I will happily do that at the bar with a pint. But yeah, timing is of the essence. So what you need to know is where can the price be and where can it not be. So what we've done here is taken the estimated imbalance price from Netztransparenz. We've taken the Picasso activation prices. We've taken the MFRR and AFRR, so the reserve starting activation prices. So you know at least where the price will not be. And then it's a question of determining is the market going to be short or long. And you can do that based on the sensitivities, based on intraday trading, and based on some other insights that we can teach you. And that will help you manage your exposure on the intraday markets. Much like the speakers of the next slots can also explain either the more human element or more the bot element. So yeah, use insight and judgment to assess risk and opportunity. That's the idea. And that's about it. So quick summary. Sensitivities, key to understanding where the market can go. Combine it with forecasting and sensitivity forecasts, and also actual behavior in the market, and that will give you enough to deal with all the insecurities that happen. And as a final remark, I will definitely recommend to keep a close eye on intraday trades, because there's never a dull moment, and intraday markets will never cease to surprise us. Thank you very much.
Perfect, John Paul. I hope you have lots of pleasant conversations over that pint at the bar. There's certainly a lot to cover. And just to add that it's very nice to have you on the team and your expertise on intraday. So You mentioned, you pointed out two key events here where prices have plunged in the intraday market in the Netherlands. And you said as well, it's only April, it's only spring. So as we go into the summer months, what were expectations there? Is this going to be more of a regular feature in the Netherlands?
I definitely think we will see more of this. I think in this case, a lot of things came together. There were probably some grid elements that weren't available, so that impacted the ability to export power to other countries. But yeah, it's going to be summer, so it's going to be sunny in more countries, so it's going to get more and more difficult to get rid of excess if you have it. And yeah, especially for a small country like Netherlands or like Belgium, you're going to have the same weather as your neighbors. So dealing with excess or shortage is always tricky, and it will require you to look across the borders. But I mean, even a big market like Germany will have those issues. And yeah, remember, you're not an island. You will have to look at Poland, Czech Republic, Austria, Netherlands, France. It's all around you.
So these negative prices could impact, Germany as well in the months.
It's a coupled market.
Yeah.
So what we saw today was, or for they had forecast for today, so all of the models were off across Europe because of the issues in Netherlands. So yeah, very interesting.
Absolutely, I'm sure there'll be lots of takers to join you at the bar. But here we have a little present from us to us, then, as you should say. Thank you very much, Jean-Paul. So we're going to stick with short-term markets, intraday markets, balancing, but we're going to go from the human touch, the human insight and expertise to machines. So the question here is, are we all going to be slaves to the algorithm? So, and to talk us through that is Amani Joas, Managing Director at CF Flex Power. Please, Amani, the floor is all yours.
Thank you. All right. So the best way I heard to start a presentation is with an apology. So here, traders don't build great slides. Traders build nice P&L. I never had the benefit of working for a nice consulting firm, but I always worked as a trader, so please forgive me if most of our slides are just snips from our screen. All right. The subject of our presentation today is short-term power trading. Have the machines taken over? And I have to thank Montel for asking me this question, because it's pretty much asking me whether I will be unemployed soon. So thanks for that. And if you already look at this image, you can see where I'm going with this talk a little bit. I pretty much put this slogan into an AI called Midjourney, and this is what it came up with within a second. So you can see the revolution of this technology taking place. All right. Sneak peek about us. CF Flex Power is a new company that we founded 1 year ago in Hamburg. And it's made up of, well, we started with 4 traders, short-term traders, so we very much have the manual clicking around in the market background, but obviously I've also worked a lot with bots. Our business model is threefold. So first of all, we do renewable energy trading. That's classical route to market, or Direktvermarktung, as you say in German. We have a small portfolio of this live right now, started in January, and looking to grow this portfolio with excellent prices, as I can tell you in one-on-ones later. Also, we're looking to get into battery trading. I think you've heard today a couple times that when we look at the market, what we see is a big need of flexibility, and we're looking to provide that both by developing projects and also trading these batteries. And last but not least is also something that came more from the market than from us. We're seeing a lot of small industrials and small producers that are looking to hedge their positions, that are looking for small PPAs, and we're looking to create more standardized product to provide people a green hedge in this situation. All right, but now let's jump into the talk. So short-term power trading, have the machines taking over. You see my agenda is very complex. It's well, yes, but not really. You will understand this a little more as I guide you through. But first, I want to start with a different point. And I think for me as a trader, or at least as a former trader, something that's very important is to always, always, always check your bias. Now, when you, in professional decision making, obviously you cannot be without bias. All of us are biased all the time. However, especially when you're in the market, it's very important to think about the outcome that you would most wish for to be true, and then to be very careful with the storyline, because you tend to overestimate it. And everybody who has been in the market knows the situation of having a position that's way out of the money, and you're sitting there and your only strategy is holding and hoping. And if you don't check your biases in these situations, you have a perfect recipe to lose a lot of money. In that sense, I think that good traders are actually less arrogant than we're often made out to be, and a lot more self-conscious, because all of us, and especially an intraday trader, will be in the situation every single day of having the feeling and the experiences of being wrong all the time. Why am I telling you this? Well, I want to make you aware of my own personal bias. And my bias as somebody who has successfully traded intraday, also manually in a team, is that, well, we've come up with strategies, executed them, and it was a good time. And for me, I would not like to have that skill set go out of value and go out of fashion. So now that you guys know my bias, it's your job to make a judgment call if this is a fair representation, or if the coming is a fair representation of the facts, or if I'm like some Kodak manager selling you to buy a new analog camera film factory in 2009. So I see that I'm not the first one who have done this, but obviously starting such a talk, I had to ask ChatGPT if the machines have taken over. And if you don't know what ChatGPT is by now, I would advise you to just run out, get on it, because it's much more interesting than what I have to say, and I really think this is the biggest technical revolution, maybe of my lifetime, definitely of this decade. And what ChatGPT says is, yes, pretty much. I won't read you out the whole thing, but just one expert, it said, a well-designed AI system can process large amounts of data quickly and make decisions based on complex patterns that may not be obvious to a human trader. Additionally, an AI can operate 24/7 without getting tired, which is an advantage in a market that operates continuously. I very much agree with this point, and I think that it's clear when we look at the capacities of this technology that AI will take over most of short-term power markets activity at some point, and more importantly, markets in general. And I think another important point from a trading perspective is that this change will not be gradual. Once the technology has figured this out, the added value of a human trader will cease to exist from one day to the next. So if we had an AI that figured out the markets, and we see it makes more money than a trader for a week, why would we have this trader sitting at the desk? So this is, I very much think this is going to happen, but we're not quite there yet. So now this was the gloomy part. The better part, if you're an intraday trader or working with intraday traders, is that the market is still very much booming. So this is EPEX data. Thank you again that I can use it. Where you see intraday volumes are still growing, and they will continue to grow. You see Germany is flattening off a little bit, but all the other markets are still in catch-up mode, and this is continue to happen. Also, I think from where I stand, when you're an intraday trader, your market value has never been higher than today. If you have Power Trader on your resume on LinkedIn, I'm sure you're getting recruiter calls all the time. So if you're an intraday trader, the situation is not at all gloomy, actually, far from it. But, and again, these are all EPEX slides. Let's start looking at the automation side of it a little bit. So on the left-hand side, you see the volume of orders. So this is not megawatt hours traded, but actually orders. And you see that they grow a lot faster than volumes. And today, we're already at a daily average of 4.5 million orders per day. And this is only going to increase. And now, when I started trading, I think it was 2016 or so, 2015, 16, I still remember if you wanted to close a position on intraday, you would see bits and orders of 100 megawatts. So you could close quite large positions without moving prices a lot. Nowadays, if I'm in there on ComTrader and I show a bid position of, I don't know, 20, 30 megawatts, I see the bots on the ask side running away from me because they want to squeeze out some extra margin. And I don't know if this is a more liquid market or a better market. I will leave that open to debate. However, bots obviously have much smaller order sizes and are jumping around a lot more than humans do. On the right-hand side, you have API Connect applications, but I'll talk about this on this slide. So basically, here this really shows you the pictures over the last year. So in orange, you see API Connect, the share of API trades versus trades on ComTrader. So ComTrader is just a manual trading front end. And it's important to understand that a trade made via an API is not necessarily a bot trade or an automated bot, but I think it's safe to assume that most of them are. Anyway, the exact numbers are not so important, but the trend is very clear. So right now, we're already above 80-20 in terms of orders for all markets. And then when it comes to volumes, in 2021, API trades overtook, or API volumes overtook ComTrader volumes. Now it's like 60-40 over all EPEX markets. And in Germany, it's already 80-20. And with Germany, I think it's safe to say that it's the most sophisticated intraday market. So this is clearly the trend. And I think if I was to stand here in a couple of years, we're at 95% on both of these slides easily. So if the question is whether machines have taken over the manual clicking around on ComTrader, then the answer is very much yes, they have, and they will. There's just no question about this. However, I don't think clicking around on ComTrader is the essential task that a good trader fulfills. It's just like moving your mouse and clicking away a little bit, but it's not actually value that you're adding. So in this case, I want to make the distinction between human decisions, or human intelligence, that is executed by automated bots on the one hand, and on the other hand is really autonomous decision-making by machines and also executed by machines. And those two are very different things. And when we're looking at these numbers, we're very much seeing a large amount of the former and a very, very, very little bit amount of the latter. So when we think about who are these bots or what are they doing, I think there are basically two or three kinds of bots that we see in the market. The most classic one will be a position closer. So imagine you have a renewable energy portfolio over the course of a day, and let's say you have a solar and a wind portfolio. Then in a modern setup, you will have new forecasts for every quarter hour of the day, every 15 minutes. So you have numbers changing constantly. And as a human trader, you have to manage 24 hourly and 96 quarter hourly products. So all of them have their own order books. And doing this as a human being is just extremely impractical because you're clicking around all the time. So the advantage of a bot in this, I think, is very clear and obvious. So the sophistication of these position closers is very, very different. And I very much think of automated execution as a tool. And the sophistication of these tools ranges from like a simple screwdriver to a very complex assembly bot that you would see on an assembly line out of an OEM or something like this. So we have position closers, and they can be very stupid, and they can be fairly sophisticated. The more sophisticated position closers are so-called VWAP engines. I think we have some companies in here that are offering products like this. The basic idea, VWAP stands for value-weighted average price engine. So these bots try to trade around when everybody else is trading because they're trying to hit an index, because people like indices for analysis and giving them to their customer and all these sorts of things. So I would say they have some real autonomous decision-making in there, but very limited. And I think the most sophisticated bots will be, well, position closers or flex bots, doesn't matter, that actually have a price model running on the back of it. So they have an opinion on where prices should actually go. And maybe they have feed-in data like from Jean-Paul, where they see price sensitivities, and they really know at what price ranges they want to trade. So this is, I'm not sure if you can see this well, this is a slide that and thanks again, that I got from PowerBot, where I want to make the point that most of these bots are not so sophisticated. So here you see bids on the green side and asks on the yellow ones, you see most of the orders over time, they're just standing there, sitting there doing nothing. And then the ones that I circled are what they call so-called egg timer bots. And when I look at it, you can't really see it, but the idea is that at some point in the market, they just jump in and they increase their prices every, 20 seconds or so until they get hit, and some of them just vanish into nothingness. So what I'm not saying is that a strategy like this is stupid. Maybe in some situation it can work quite well. However, when you talk to any intraday trader that's trading the market every single day, they will tell you that they see extremely stupid bots all the time. So the sophistication of these machines is just not super high. The last part of bots that I haven't talked about are flex bots. So bots trading flexibility. Their basic logic is, let's say they're trading a gas peaker. They will have some idea of the marginal cost. They will have some idea of the option value of the plant. And they will have some sort of optimization trying to get the most value out of their asset. And now, when you look at the growth of these, when we look at the current state, or especially to the past, and you have a 500 megawatt gas peaker, that asset will be big enough to fund a trading team sitting there and trading these assets all the time. Like that's okay. But now, and I'm sure the next speaker will tell you all about this, when we move to a world where we don't have one 500 megawatt gas peaker, but 55 megawatt batteries that all have different cycling restrictions, all have different states of charge, then it's simply impossible for a human to sit around and manage all these assets at all time. There's just no way. So there's definitely automation in this. And then some of these bots, and I think some companies are more sophisticated than others there, that have some AI that actually maximizes revenues over time and adjusts their trading strategies in this way. But I would still say overall, when it comes to AI, like proper AI in trading, we're not really seeing the most impressive stuff there yet. And that brings me to the second part of my talk, which is, have machines taking over? And the answer is, well, yes, but not really. And again, check my bias, which is why I love this tweet by Nassim Nicholas Taleb, which I've changed to: power trading run by technologists is just like food cooked by pharmacists, books written by printers, operas composed by sound engineers, and planes flown by mechanics. I'm not sure if this is still 100% fair when you look at what ChatGPT can actually do and the other AIs, but I do very much think that the kind of autonomous decision-making that we're looking for, or maybe afraid of in the future in trading, is something that's still struggling quite a lot, and it's especially struggling in special situations. So, exactly. So I think the measure of where AI is, and when I would admit that AI has taken over, is not when we have some flex bots doing some cool stuff, but when AI really has taken over risk-taking and prop trading, because I think that's the highest level of sophistication that you can have. So again, what does ChatGPT say when I ask him, do humans still have a role to play? And again, I really like the answer. It says, I want to say he, or if it's a she, I'm not sure, let's stay with it. Humans might outperform in AI in situations where there is a high degree of ambiguity, uncertainty, or unpredictability. For example, in situations where the outcome of a decision depends on human intuition, creativity, or empathy, humans may be better suited to make decisions than AI, and humans are also better at handling situations that require moral or ethical judgment. Not 100% sure on the last point, because that very much depends on the human making the decision. But let's just leave it at that. Or actually, no, one more point on this one. So humans do good in situations of uncertainty. And on intraday markets, just like Jean-Paul said, we're seeing situations that we've never seen before, or that are highly irregular, pretty much on a weekly basis. So when we tend to build a bot that is successful, it's good 90% of the time, but then it better has an off switch built in for these crazy moments. And the way, or the situations where an AI does very well, is when you have great quality of data and data structured in a very good sense. And these are just two things that we don't have on intraday markets. There are companies doing a better and better job, but data quality and trustability is just not very high. And the second problem that we have is that AI tends to do very well when the rules of the games are stable. So AI has beaten humans in chess a long time ago because chess is a quite stable game. However, when the rules of the games are flexible, such as like poker took a lot longer to beat than chess because there's a large element of uncertainty in there. And this is something that we see a lot on intraday markets, where when you trade quarter hour 13 Q4 today, quarter hour 13 Q4 tomorrow, it's a very different product, and they're difficult to compare because you might have different border flows, different renewable settings, and so forth. So training the AI on a stable setting is not at all that simple. And then also you have bigger rule changers that's difficult for AI when you're training it. So let's say you have a war in Ukraine, where price levels just jump up to a level and volatility jumps up to a level from pretty much 1 week to another. And AI just simply hasn't been able to train on these data sets, so it won't be able to know what it does. Or you have new imbalance rules switching from average pricing to marginal pricing, or you have somebody putting a cable, 1 gigawatt cable from one country to the other, which changes the power flows, which also obviously has commercial ramifications. So with all these rules switching, AI has a hard part understanding. And so my argument is very much that humans still have a bit of value. And actually, last point that I want to make is what we're lacking also in the development of AI is just expertise, because the guys from OpenAI that built ChatGPT are just not looking at intraday markets. I think if they flew down, checked out intraday markets for half a year, it would be over pretty soon. But we've been waiting for 5 years for this to happen, and it simply hasn't. So I don't want to be like the chicken that loves the farmer because I haven't gone to the butcher today. But I think humans still add value in special situations. So I want to look actually at April 10th. Jean-Paul, you've been talking about April 11th. I would love to see your sensitivity analysis for April 10th, because that was a day. Here you're looking at average intraday prices, and you see they're going quite crazy. These are the last 6 months. And on April 10th, which is Easter Monday, we've seen them drop down to 1,000 euros, which is not something that we've seen before. So what happened on this day? The weekend before Easter Monday, we were sitting together looking at Easter, as we always do, and thinking about trading strategies. And we saw that we had negative residual load of 12 gigawatts. So load minus renewables came down to minus 12, so way too much power in the system. And general theory in the past, and this is what machines are looking at, would suggest not so much would happen. Because in Germany, usually at a price level of minus 80, you have a lot of renewables shutting off, maybe a bit of demand is going up, maybe the few batteries that we're charging are going up, but prices don't usually drop below minus 80. However, our theory was that most of what you have curtailed on intraday markets is usually wind, and on this day we simply didn't have a lot of wind, but mostly solar. And also the massive build-out that we had last year means that we have a lot of extra capacity added that is not very much flexible. So we thought that prices could drop through that, and then the question is, what is the limit? How far can they go? And our idea was, well, they could go as far as marginal imbalance prices, so maybe into a direction of minus 2,000 euros. This just quickly, so these were day-ahead prices. You see they go down to minus 75, minus 80, what we expected, but nothing crazy. And then here, these are pretty much the slides that Jean-Paul showed, only that the 11th is in the middle and the 10th is next to it. And you see that renewables are far over the red line. So we just have essentially too much sun in the system, and this will only grow to happen in the future. So what happened on intraday? Well, prices decreased down. We had average prices of minus 1,000 euros. And now let me come back to what I'm actually talking about. Why am I telling you this? Is, well, bots do terrible in situations like this, because in the past there's just no situation that they can train on. And I'm very much sure that any renewable portfolio that's managed automatically probably was shut off at a price of minus 80. Pretty much every battery that you have in the market is charged at a price of, if they're smart, minus 200, but nobody saw prices going down to minus 2,000. So this is a bit of human action, and forgive me the bragging. It wasn't me, it was a colleague. So on the left-hand side, you see an order book. I think this was at around 1250. And you see an ask at 13 to 14 of minus 1,000. And then to the right-hand side, you actually see executed orders where somebody went short, so sold power, paid to sell this power at minus 1,500 euros, and then bought this power back at minus 2,000 euros. I'm pretty sure that you will not find a bot today in the market that is able to execute this kind of trade. And that is why human traders with a bit of experience are still quite successful in this market. So let me conclude this with a bit of vision, and this is a little bit of advertisement, something we drew up, but I won't get into it too much. So we believe that the automation of execution it's pretty much already happened and it's here to stay. However, bots struggle in special situations. So for us, we think human expertise and bots still belong together for a while to come. So we have, as traders, we have built bots for the last 5 years, and building a bot is not a big deal. The level of sophistication depends what you're interested in, but we can do this. However, our philosophy is that we have a manual override button on these bots, and when we see the crazy situations, we take over the steering wheel and we go into infighting mode, and these are the situations that tend to be the most profitable situations on intraday. And this benefits not only us, but it benefits our clients because we can offer them services at lower costs. It benefits flexibility because we can give them higher revenues. And we still believe that it's pretty much the ideal combination. So we'll take AI over intraday trading. Yes, I think at some point, but I think if you're an intraday trader, you still have a day to live, maybe a decade. Time will tell. Thank you very much.
Thank you very much, Shamani. Very, again, very thought-provoking. So you have sort of 10 years, basically. Yeah. By 33, you know, who knows if we'll be here then? We could all be bots by then. Yeah. Yes. We talked about market design today, a little bit about carbon, and these are elements that mostly statements or policy direction or guidelines will drive markets further out on the curve than intraday. But are bots good at picking up, for example, if there are statements coming from policymakers or some kind of, where is that something that they are useful, or is that also where they're more fallible and unable to maybe follow, if markets move quickly due to policy announcements or statements?
Right. So I think longer on the curve. So can bots generally do this? Yes, of course. Like you have, especially in stock markets, you have bots going through Twitter at all times, and they're only trading on these signals. I think a lot of the crypto bots were working on these kind of signals. So in principle, yes. That you have them on short-term power markets, no, we're definitely not there yet.
Not yet, but maybe that's the direction of travel. Any questions from the floor? Yeah.
I think it's super fascinating. I have two questions. I'll squeeze in both. The first one is, are there already bots that are out there to try to fool the other bots that don't care about supply demand and just...
Yes.
Is that true? And I'll say the second question because it's linked there. And how about, let's say, what's it called in German, BaFin and the finance inspection authorities? Because when we tried to do those tricks in the early days, it was okay. But for example, if you put an offer today and start filling up with a lot of bids below, then you will get a call from them.
So that's spoofing, right? So you have a bot and you have another order that just pushes it up, which you're not allowed to do. So they're you
don't get away with it because it was not intentional. It was just creative.
So I think the policing around this is quite lax. I also don't think that building these kind of bots is not where you're going to get rich. Maybe some people, I think it's something that more people play around with and have some fun doing. You do see them, like when you have a badly designed bot, it just gets pushed up all the time. So yes, this happens. Personally, I don't think it's a very big deal, but as the importance of this market grows, I'm sure BaFin will have a look eventually.
So no malicious bots in the market?
not ours.
Okay, okay. We have a little present for you before you go. Here you are.
Thank you very much.
Very much again. Thank you. Thank you. And the final speaker today will talk us through, we've been mentioned several times today, and batteries. So to talk us through the cross-market optimization is Jürgen Falter of Inspired. Jürgen, please. I know you have a difficult role. The last presentation of the day, keeping us from our refreshments, but I'm sure you'll do absolutely fine. So
I hope so. So thank you very much for having me today. I'm super happy that so many people stay, because it's really the last one between the well-deserved beer and dinner today. Thank you very much for the last presentation. I think it was fantastic, but maybe I have to disappoint you a bit, because it's not now the battle between AI and human traders, because I'm talking about cross-market battery optimization today. But of course, looking into what Inspired is about, Inspired is an AI power trading company. So in general, we believe in this kind of technologies. So what we do is exactly that we trade flexibility of our customers on the short-term power markets with our technology. So maybe to link it at least a bit to what we have heard so far in the last presentation, because I think there was a very good link to this presentation. Amani told us that there is one thing where AI-powered and algo trading stuff will be very helpful and useful, of course, which is especially complex flexibility like batteries. You know, all the battery stuff has this kind of state of charge management, temperatures, a lot of warranty conditions. So it's quite tricky to just oversee all this as a human and then do the right trades. So this is where exactly this topic of algo and AI power trading comes in on the short-term power markets. So this is what we do as a trading service for our customers. And today, I really want to talk about this cross-market optimization of batteries and why this makes a lot of sense. So what we have seen in the markets, and I took this example of Germany, what we have seen in the last years is that the major amount of batteries are just marketed in ancillary services. We have it here, especially in Germany, in FCR. Now EFRR is coming. Everybody's talking about EFRR. And then next to it, there is wholesales, and sometimes it feels like a bit like it's wholesales or ancillary services, but that's not the fact. It's really about cross-market of all of this, and we will go a bit more into the details and to the depths of this topic, and I really want to give you some educational pieces today and some takeaways why this makes sense and how to do that. Maybe just talking about other countries as well, so what we also have seen in other markets, and it's generally true in whole Europe, that it's mainly marketed in ancillary services when we talk about batteries, because in Belgium it's AFRR, in UK it's other ancillary services, but it's more like focusing on this kind of market. But what we see, and just taking here FCR as an example in Germany, that of course prices will decrease over the next months, will decrease over the next years, and have already decreased in the past. So whatever business case was built on for a battery based on pure FCR, now people get starting nervous about that. And everybody who is in contact with us is of course asking about what will be the future? Is it pure FCR, EFR? What's the truth? And how to minimize the risk. And this is what the topic about today. So cross-market battery optimization to minimize risk by maximize revenue, because you just have to be prepared for the future. Yeah? It's not A or B, it's maybe A, B plus C. Yeah? So really just be prepared. And we will see this in similar situations in other countries for other types of ancillary services. I can very good remember our first talks when we talked to potential customers in UK like 1 year ago, and it was like there will never be a chance that you market the battery wholesales in UK. There is so many opportunities with ancillary services. And then even 6 months later, in September, Energy Trading Week in London, already a lot of people were talking to us about what exactly is going on with this wholesale stuff and how exactly is it done. And now we are really somehow pushed a lot for also providing this kind of opportunities also for UK, for example. So everybody, I would say, is well aware of this situation, and it's good to be aware of it. So again, example Germany, what we have seen, Sometime in the past, somebody told me, these are nice iPhones, it should be batteries. I hope you can identify it as a battery and not as an iPhone. And we have here an example of a 10 megawatt, 12 megawatt hour battery. So a typical battery which was marketed in ancillary services before in FCR. And you have all this typical stuff like pre-qualification done for 8 megawatts, and you just put it into FCR. You make your money out of FCR. You're happy, business case done. But with a falling FCR price, it's not so happy and not so fun anymore. So then there are a few options to just do cross-market. So meaning staying with FCR, but putting on top some additional stuff with wholesales, but just using the residual capacity of the battery and doing active wholesales management, wholesales market of the battery, including SOC management. Of course, by always, and this is important, really always staying within the warranty conditions. So it's not about driving crazy with a battery, going 10 cycles and doing some crazy stuff. So it's always about really caring about cycles, temperature, SOC. So this is why it's a complex mathematical problem and why it makes sense to use AI and algos for this kind of trading stuff. So we call it light diversification here by just staying with FCR and putting on top some wholesales. And then, of course, doing some pro diversification to really decide which part of the battery to put to which market. And this is a very simplified picture here, and we will go into more details now to show you a bit why or where is the complexity. And I hope there is some takeaways for you for how we do things or how general things could be done on battery marketing. So this is my so-called weather chart. It's always tricky because it's difficult for you to see maybe what is there, but I will explain. So what you see on this nice weather chart is just 18 months of a battery, 18 months of a combined or cross-market approach of a battery. What you see on the y-axis here are 8 megawatts. By putting 8 megawatts into FCR, the result of putting 8 megawatts into FCR for these 18 months was 2 million euros in revenues. I hope you can read it that there is this 2M on the black line from the left upper side to the right side down. Yeah, I think there is this laser. Yes. So from here to here, you see this 2 megawatts. This 2 million, sorry, it's 2 million euros, this line. And it's provided by just putting 8 megawatts to FCR. This is the y-axis. And the x-axis is by putting the battery with a number of cycles into wholesales, pure wholesales. Yeah? And what you can see when you follow this 2 million line, you end up at approximately 2 cycles. So what does this mean? This means by putting the same battery with 2 cycles on wholesales, you make the same revenue by putting it with 8 megawatt in FCR. So, and if you do that, you will be super stupid. Because making 2 cycles on wholesales compared to making 0.8 cycles on FCR, by making the same revenue, degrading the battery a lot, it's just not the use case. So nobody will do that. So that there is the big but, and there is a nice weather chart. And when you look at the right upper side, there you see the magenta color. And this is now the combination of doing things. So when we take 6 megawatt of this battery to FCR, and then taking just 2 cycles of the residual capacity, meaning the residual 4 megawatts of the battery, and doing this 4 megawatts with 2 cycles, so meaning on the whole battery it's not 2 cycles, on the whole battery it's a lot less, then we end up at 3 million revenue. So adding 50% of revenues by just splitting the battery on average over these 18 months, 6 megawatt FCR, and putting the residual capacity to wholesales. And I would say this is quite significant, and it's something you should think about when you're owner of a battery. If you want to add 50% of revenues by just adding half a cycle, not half a cycle, less than half a cycle of to the daily cycle ratio. Yeah? And now there comes the next magic. This is how it looks when you look at 18 months. Because what we have seen before in this one chart was just the overall of 18 months, yeah, the summary. And if you look onto a monthly basis, you will see that it looks super different. So there is a lot of difference if you look at it, for example, in month number 10 of these 18 months. There you see there is a really flat or really small area of magenta. So meaning that you have, for example, you can read it 280 Ks for putting the battery in FCR. And you have maybe only 118 Ks for putting this battery to wholesales. So in month number 10, you would put more capacity of the battery to FCR and less capacity to wholesales. And looking into month number 18, you will see that on FCR you make maybe something like 90K, and on FCR you make about 200. On wholesales you make 200 plus revenues. So what just I want to indicate here is that it's just a matter of looking into the situation on a frequent basis, and frequent means daily at least. So it's not about a one-time decision. I take my battery, put it 50% FCR, 50% wholesales, and then I'm done for the next month. No, it's a daily optimization problem. And if you solve this daily optimization problem, you can, of course, do a lot more revenues with your batteries by not harming any warranty conditions, once again. So this is very crucial. So this is why algos make sense here in this mathematical optimization problem. And the magic behind it, of course, is looking into different markets, looking into Germany, UK, Belgium, France. So wherever you go, it's a different ancillary services topic. It's a different market topic. So how liquid is the market? Which products are available? So it's really complex. So this is the message. But it's worth solving this complexity, because what we have heard today as well, energy transition, so this is why we are here as well, as Inspired, supporting the energy transition by by providing flexibility to the market. And storage is one of the coolest flexibilities we have, battery storage, and they are growing. There's a super big number of batteries joining the market in the next years. So for sure there will be optimization or cross-market optimization problems, because everybody who puts a battery there wants to earn money. And it's about really just making also the business case safe by diversifying revenues, and minimizing risk, meaning you just have to look at different markets. And so how we do it, as I already mentioned, so the key is to do it on a daily basis. And what we're already working on, for example, is really to decide it on a 4-hour block basis, for example, to really go not just for this day, my split between FCR, EFR, and wholesales is like this, really thinking about doing this on a 4-hour block basis, for example. Yeah, so additional complexity will be added over the next weeks and months, but this is crucial to making all this stuff possible. And just my very last slide, just one thought we had, and we have seen also in the past, thinking about this, like what happens with batteries which are pre-qualified or which are in the process of pre-qualification. Also here, you can just add wholesales before the battery is pre-qualified, and then you can start splitting it in all the pre-qualified markets as well. So it's just how we're always thinking about how to maximizing revenues for our customers and how to make the business case value for all. Yeah, so that is it in a very nutshell, and I hope it was quite short, and everybody is now well prepared for beer and dinner.
Very brief and concise to the point. Very good. Thank you, Jürgen, very much. Just a short final question.
Yeah.
In terms of the regulation and policymakers, is that fit for purpose here, or what would your wish list be for regulators, both in Germany and at the European level?
Difficult question, to be honest. I think with a lot of answers.
Yeah.
I think we have heard a lot today some things about CFDs and all these other kind of things which are upcoming about market coupling. I think there are a lot of pros we see which help us in supporting, and what of course also supports these kind of scenarios is really let the market work at the end and not regulating it too much. Yeah. But also by regulation, like coupling markets and all this kind of things, it's quite interesting to keep it closer to each other and not having just the last hour maybe split it between different power exchanges, etc. So, but it's not a regulation issue; it's a technical issue. But yeah.
Well, any questions from the floor? Maybe I see a few thirsty people out there.
Yeah, it looks like.
Yeah. So. a small present from us, Jürgen, and once again, thank you very much.
Thank you.
Thank you.